Hello students, good evening all. Let me check whether my voice is audible or not. Hello. Hello students, good evening all. Let me check whether my voice is audible. Yes, voice is clear. Due to power cut in the afternoon session, so I have not yet completed retirement of a partner. Now, first within 1 hour, we try to complete the partnership accounts, retirement, death and dissolution. Then after we go to company accounts, students. Okay. After understanding admission of partner, most of the adjustments will cover again in case of retirement and death. When it comes to death of a partner, there are two different types of problems they may ask that we will discuss in case of death of a partner. Now come to retirement of a partner. Sir, what is the situation of retirement of a partner? Suppose let us assume there are 3 partners in a firm or 5 partners in a firm. One partner, out of them, one partner is leaving the organization permanently. So this situation is called retirement of a partner. Why the partner retires? What is the effect of retirement? We are not going to discuss all those things here. We are here to give accounting treatment when a partner retires from the partnership firm. We are here to give what is the accounting treatment when a partner retired from the business. Hope you are following. Yes, sir. Now, whenever a new partner is admitted, he will bring capital. Whenever we start a new business, and partners will contribute capital. Whenever a partner is retiring from the business, he will take back his capital. Yes or no? When we repay the amount due to the retiring partner, retirement of partner is completed. Now look at what are the various adjustments we do. First and foremost adjustment is revaluation of assets and reassessment of liabilities. This is exactly similar to admission in case of admission of a partner. What are the differences? First, the revaluation profit or loss is distributed to old partners in old profit sharing ratio in case of admission. But in case of retirement, the profit or loss on revaluation is distributed to all partners including retiring partner. Is it clear? Yes. Here also the memorandum revaluation account concept comes. When the continuing partners, suppose there are 3 partners A, B, C. C retired from the firm. Now who are the continuing partners? A and B. A and B may agree that the assets and liabilities value should not vary or change. Okay, fine. In that case, they follow memorandum revaluation account. The principles or methods of preparation of memorandum revaluation account is exactly similar to admission. The only difference is in case of admission, memorandum revaluation account part 1, profit or loss is distributed to old partners in their old profit sharing ratio. When it comes to part 2, memorandum revaluation account, profit or loss is distributed among all partners including new partner in their new profit sharing ratio. But here what we do, in case of part 1, profit or loss, it is distributed to all partners including retiring partner in their old profit sharing ratio. When it comes to part 2, profit or loss is distributed to only continuing partners A and B in their new profit sharing ratio. That is only the difference. Next, distribution of reserves and accumulated profits. Distribution of reserves and accumulated profits. In case of admission, the reserves and accumulated profits are distributed to old partners in their old profit sharing ratio. But here in case of retirement or death, the reserves and accumulated profits are distributed to all partners including retiring partner or deceased partner in their old profit sharing ratio. Or else the reserves and accumulated profits may be distributed the share of retiring partner or the share of deceased partner only distributed to him. Means remaining partners may continue. A and B are continuing. Yes. Take the share of reserve and the share of accumulated profit of C alone and distribute to him. Automatically what happens? Earlier in case of admission, total reserve and accumulated profits are distributed. But here what is happening? Only the share of retiring partners, only the share of retiring partner is distributed. That is an important factor here. Or else simply to avoid all those confusions, what we can do, all reserves and accumulated profits distribute to all partners in their old profit sharing ratio. Next one, computation of new profit sharing ratio and gaining ratio. In case of admission, we have calculated sacrificing ratio. What is the formula for sacrificing ratio? New old ratio minus new ratio. But this is retirement. See, let us assume one is A, B, C are sharing profits and losses as 1:1:1. Suppose C is retiring, means C's share of profit is taken by A alone or B alone or A and B. That means both the people. Suppose if the share of C is taken by A alone, A will get benefit. A has to compensate goodwill to C. If the share of C is taken by B, B is getting benefit. B has to sacrifice. B has to compensate goodwill to C. Or A and B both gained. So both people should compensate goodwill to C. How they compensate? In their gaining ratio. What is the formula for gaining ratio? New ratio minus old ratio. New ratio minus old ratio. In case of admission, goodwill is brought by the new partner. In case of retirement, goodwill is taken by the retiring partner. That is only the difference. Goodwill distribution, same. In case of admission, the existing partners will sacrifice their share in favor of new partner. That's why he is compensating goodwill. In case of retirement, the retiring partner is giving his share of profit to existing partners. That's why the existing partners means the gaining partners will compensate goodwill to C. Next one, valuation of goodwill and its accounting treatment. 99% chances are there they give you the value of goodwill of the firm. So next, pending accounting treatment. In case of retiring a partner, the goodwill adjustment is very easy. Why? Here goodwill is contributed by whom? Gaining partners. Simply one entry we write, gaining partners capital account debit. Gaining partners capital account debit to retiring partner capital account. Retiring partner capital account. That's it. One single entry for goodwill. Calculate the share of retiring partner, the share of goodwill of the retiring partner and record this entry. Calculate first share of retiring partner, share of goodwill of retiring partner, second one gaining ratio. In this gaining ratio, you distribute this. So gaining partner capital account debit to retiring partner capital account. And very important adjustment is joint life policy or separate life policy. Now we don't have much time to discuss in detail about joint life policy or separate life policy, but I will discuss one small technique how this joint life policy or separate life policy is adjusted when it is given in the examination. Okay, next one, adjustment of capitals of continuing partners. We have seen in case of admission of partner, when all partners including new partner, after admission of the new partner, if all partners agree to maintain their capitals in proportion to their profit sharing ratio, then this capital adjustment is done. Otherwise you need not to do it. Here what is happening? After retirement of C, if A and B agreed that we contribute capital in proportion to our profit share, then this capital adjustment has to be done. Next one, determination of amount due and settlement of the same to the retiring partner. In case of admission, the new partner will bring amount of capital, but in case of retirement, the existing partner or retiring partner, he will take whatever the amount due to him. These two adjustments are new for us. Adjustment of joint or separate life policy and determination of amount due to the retiring partner. In case of death also, we do the same adjustments, 7 adjustments. In addition to that, we do one more adjustment, that is share of profit till the date of death. Share of profit till the date of death. Is it clear, students? Yes. Now look at, we try to solve one problem. By solving problem, we understand more concepts. Look at, I told you already, here I am helping you to solve the problems to the extent possible. What is the process we have to follow? Okay, what is the process we have to follow in the examination? Yes, to the extent possible. See, our aim is to attempt the accounting paper to the extent possible. Suppose one tough problem is given. Okay, in every tough problem, a student can solve 50% of the solution. Suppose toughest problem is given in the exam. Okay, out of that you can solve 50%. Solve 50% and come. You get proportionate marks, na? Is it clear, students? Okay. Yes. Now look at A and B are partners. Excuse me. A and B are partners in a business sharing profit and losses as 3 by 5 and 2 by 5. Nothing but 3:2. Their balance sheet as on 1st January 2022 is given below. In case of admission, retirement, compulsorily they give you balance sheet and additional information. But in case of death, there are two possibilities. They give you the balance sheet and additional information, and we have to prepare, we have to do the adjustments and prepare the new balance sheet. Or in case of death, they may also give you different information. They give you after death of the partner, what are the various adjustments we have to do in the books of accounts. And finally, we have to calculate what is the amount due to the executors of deceased partner. Clear? Look at. So how the information is given? You have to keep one thing in mind. They give you the information. They ask the requirement. What you have to do? You have to convert the information into the requirement. I repeat, this is the information. This is the information. What is the requirement? Journalize the above transactions in the books of the firm and close the partner's accounts as on 1st January 2022. Give also the opening balance sheet of A. This is the requirement. Information, requirement. Convert this information into requirement. We are understanding that. How the information is converted into requirement. Hope you are following. Yes, sir. Now look at the first one. Liabilities. Capital of A, capital of B. Immediately open partners' capital accounts and show these things as opening balances. By balance brought down 20,000, 15,000. A, B. Next, reserve. How much reserve? Here we have 15,000. Immediately distribute this reserve to the partners. What is the entry we record? Reserve account debit to A capital to B capital. What is the ratio? 3:2. 15,000 into 3 by 5. 10,000 and 5. Sorry, just a minute. 15,000 into 3 by 5. 9,000 and 6,000. 9,000 and 6,000. Over. See, entry he is asking, na? Yes. Next. Posting, look at. Okay, partners capital accounts not prepared. You people prepare, no problem. Next. Trade payables. Trade payables. Observe carefully. If there is no change in the trade payables, show trade payables as it is. Show trade payables as it is. See, trade payables 7,500. There might be some adjustment. Next, come to asset side. Plant and machinery, inventories, trade receivables, balance at bank and cash in hand. Two balances given. Balance at bank and cash in hand. Here what we have to do, if any asset value changed, change accordingly. First, show the change in revaluation account. After that, take the same amount to balance sheet. Simultaneously, you try to solve it. Next, B retires from the business owing to illness and A takes over it. A takes it over. The following revaluation was made. The goodwill of the firm is valued at 25,000. What is the share of A out of 25,000? 25,000 into 3 by 5. 15,000. Here there are only two partners, A and B. B is retiring, A is taking over the business. Means A will gain total share of B. Yes. So who will compensate this goodwill to retiring partner B? A. Yes or no? Sorry, just a minute. Not 15,000. 25,000 into B is retiring na 2 by 5. 10,000 rupees is the share of goodwill of B. Then what is the entry we record? Gaining partner capital account debit. A capital account debit to B capital account. Over. A capital account debit to B capital account. Next. Depreciate plant and machinery by 7.5% and inventory by 15%. Plant and machinery 7.5% decrease. Inventory 15% decrease. Accordingly, you write the entry. What is the entry? Revaluation account debit. to plant and machinery account to inventory account. Over. Next, doubtful debts is raised against trade receivables at 5%. Trade receivables how much? Trade receivables are 15,000. 15,000 into 5%. 15,000 into 5%, 750 rupees. Revaluation account debit to provision for doubtful debts account. Next, discount reserve against trade payables. Actually, discount reserve or provision for discount on creditors is a gain, future gain. As per prudence concept or as per conservatism concept, we should not create any discount or reserve on for discount on creditors. But in in this problem, they said create. You create. What is our creditors? 7,500 into 2% means 150 rupees. This becomes gain for us. What is the entry we record? Discount reserve or reserve on reserve for discount on creditors account debit to revaluation account. Look at reserve for discount on trade payables account debit or creditors account debit to profit and loss adjustment account or revaluation account. Okay, next. That's it. That's it. Here, if you observe, they did not mention whether B account is settled or not. Observe carefully. Here they did not mention whether B account is settled or not. In the absence of information regarding how the retiring partner's capital account is settled, it is better to transfer retiring partner capital account balance to his loan account. I repeat, irrespective whether any information is missing regarding how the retiring partner capital account is settled. In that case, it is better to transfer the amount due to retiring partner from his capital account to his loan account. Finally, observe here. Yeah. Finally, amount due. If you prepare B's capital account now, then the total amount due to B is 29,200. Transfer this to his loan account. Over. Now look at balance sheet. Plant and machinery decreased, decrease. Inventory decreased, yes. Trade payables 15,000 minus provision, yes. Balance at bank, no change. Cash, no change. A's capital changed. Here we have to compulsorily prepare partner's capital account. Otherwise, how can we calculate how much amount due to B and what is the capital due to closing capital of A? Next, trade payables, they said 7,500 minus provision 150. It's a simple problem, students. It's a simple problem. Now look at the next problem and very, very important problem. FGK were partners in LLP, limited liability partnership, sharing profits and losses at the rate of 2:1. K wants to retire on 31st December 2022. Okay, who is retiring? K is retiring. Who are the continuing partners? F and G. Given below is the balance sheet of the partnership as well as other information. First, observe the liability side. Capital account of F, G, K. Immediately what you have to do? Open partner's capital account. Post these things as opening balances. By balance brought down. Next, reserve is there. Reserve is there. If nothing is given in the problem regarding reserve, do one thing. Straight away distribute this reserve to all partners. Straight away distribute this reserve to all partners. What is the entry we record? Reserve account debit to F capital, to G capital, to K capital. In which ratio? 2:1 ratio. Over. Next, trade payables. If there is no change in the trade payable value, straight away take this trade payables to balance sheet liability side. Next, sundry fixed assets, inventories, trade payables, including bills receivable 20,000. Including bills receivable 20,000. Okay, bank balance 50,000. Bank balance 50,000. Now look at how the assets gets changed. F and G agree to share profits and losses in 3:2 in future. This is the new profit sharing ratio. Old profit sharing ratio 2:1. So that here we calculate gaining ratio. Who is retiring? K is retiring. What is the share of K? 1/5. And this is taken by F and G. How they have taken? That we calculate by calculating gaining ratio. In future, okay. Value of goodwill is taken to be 50,000. What is the total value of goodwill? 50,000. Here you can observe goodwill adjustment. Okay, F, G. K is retiring now 1/5. F old share 2/5, new share 3/5. Calculate gaining ratio. Gaining ratio is 1/5. So F is gaining and K sacrificed 1/5. Total share is taken by F. Means if you observe G share there is no change in the G share. Earlier we have 2 by 5. New also he has 2 by 5. So no change. Means the total share of goodwill, case share of goodwill, is compensated by F only. How much? 50,000 into 1 by 5, 10,000 rupees. What is the entry we record? Gaining partner. You have to remember this. Gaining partner capital account debit to retiring partner capital account. In case of admission, incoming partner capital account debit to sacrificing partner capital account. Okay, students, look at F capital account debit to case capital account. Over. Next. Sundry fixed assets are revalued upward by 30,000. Means earlier we have 1.5 lakh. Now upward revaluation 30,000. What is the entry we record? Sundry fixed assets account debit to revaluation account. Go to revaluation account, credit side, write down 30. Go to balance sheet, write down 1,80,000. And inventories by 10,000. Inventories are upward revaluation. Earlier we have 50,000. Now increased. Go to revaluation account, credit side, write down 10,000. Again go to balance sheet, write down 60,000. Next, bills receivable dishonored 5,000. Bills receivable dishonored 5,000 on 31st December 2022. What is the entry for bills dishonored? Debtor account debit to bills receivable. This is the entry we have to write. In that case, what happens? Bills receivable decrease by 5,000. Debtors total trade receivables become same. I repeat, if we pass the entry for bills receivable dishonored, then bills receivable decrease by 5,000. But whereas trade receivables shows same amount. Why? Because debtors account debit to bills receivable now. We record the entry debtors account or trade receivables account debit to bills receivable. But here what happened? But not recorded in the books. Dishonor of bill was due to insolvency of the customer. Insolvency of the customer means what? Now we are unable to recover amount due from him. In that case, the total amount of bill is transferred to the revaluation account. In that case, trade receivables also reduced by 5,000. If this much of information is given, if this much of information is given, what is the meaning of that? Bills receivable decrease, debtors increase. But here they have given dishonor of bill due to insolvency of customer. Means permanently the reduction in bills receivable and debtors also. So now the new bills receivable is, trade receivables are 65,000. In the bracket we write including bills receivable 15,000. Revaluation debit 5,000. Over. F and G agree to bring sufficient cash. Yes. In the entire problem, this point is important. F and G agree to bring sufficient cash to discharge claim of K and make their capital proportionate. Or now the next question comes. How much? How much amount F and G will bring? That's the question mark. Here the capital adjustment. Look at. Also, they wanted to maintain 75,000 bank balance for working capital. Here the question mark is how much capital they contribute. To know this, first of all, we should understand what is the total capital of the firm. If we know the total capital of the firm, this can be shared between F and G in 3:2 ratio. After distributing the total capital, now we check how much of actual capital we have in the business. The difference capital they may bring. But here, how much is the total capital? Means they have given a hint. What is that hint? We know the accounting equation assets is equal to capital plus liabilities. Yes, sir. Here we have all assets information, all liabilities information. In that case, easily we can calculate capital. Na? Capital is equal to assets minus liabilities. Yes, we have all assets information and all liabilities information. Only thing we need now, capital. But here bank balance they have given 50. But what is the new bank balance? 75. If the required bank balance is given in the problem, that indicates that you have to calculate capital in this manner. Assets minus liabilities. This working note finally is very, very important. Look at sundry fixed assets, inventory, trade receivables. These are changed values. New values. These must be written in the balance sheet. Bank balance 75. Total assets minus sundry creditors. This is the required capital. This is the total capital of F and G after retirement of K. Now this is shared by between F and G in 3 is to 2 ratio. 3 by 5, 2 by 5, 198, 132. These are the closing balances. These are the closing balances. Now what we do immediately, these can be taken as closing balance. Now we balance F and G account. They will bring the required cash 70,000 and 34,000. Observe carefully. Now finally, what is the amount due to K? 79,000. Finally, we repay amount to K. In the new balance sheet, observe sundry fixed assets, inventories, trade receivables, bank balance, and this 1,98,000 and 1,38,000 we show as capital. Trade payables 50. After retirement of K, the balance sheet size also decreased. Look at. Yes, this is how we solve the problem. Right. So they are asking past necessary journal entries and draft the balance sheet. Okay, everything is okay. Once you know the procedure of solving problem, however the problem it is and whatever the problem it is, we can simply calculate it or solve it. Right. Next look at illustration 3 once. A, B and C were partnership sharing profits in the proportion of 5-4-3. The balance sheet of the firm on 31st March 2022 was as under. Look at capital A, B, C and trade payables. Next, fixtures, inventories, trade receivables and cash balance they have given. Okay, A had been suffering from ill health and gave notice that he wishes to retire. Okay, who is retiring? A is retiring. An agreement was therefore entered into as on 31st March 2022, the terms of which were as follows. A is retiring now. Yes. What are the terms and conditions? Look at. The profit and loss account for the year ended 31st March 2022, which showed a net profit of 48,000, was to be reopened. Yes. This is very, very important, students. This is very, very important adjustment. The profit and loss account for the year ended. You people observe, we are on what date? 31st March 2022. They are saying that 31st March 2022 already P&L account prepared, P&L appropriation account also completed and balance sheet also prepared. Observe, 31st March 2022 all the final accounts completed. Trading account, P&L appropriation account and balance sheet. But now what are the terms and conditions? They are agreeing that okay, we reopen the profit and loss account. How much? 48,000. What is the profit? 48,000. Okay. B was to be credited with 4,000 as bonus. These are the new terms and conditions. First, for opening 48,000, what is the entry we have to record? Already this profit has been distributed to partners earlier. Now we reopen it. What is the entry we have been passed in the past? P&L appropriation account debit to partners capital account. Now that entry becomes reverse. Partners capital account debit to P&L appropriation account or adjustment account. Yes, this is very, very important entry. Now after reopening the P&L account 48,000 profit. Now what we are doing? We are giving bonus to B. How much? 4,000 rupees. Okay. So P&L adjustment account debit to B capital account 4,000. Next, in consideration of extra work which had been developed upon him during the year. Okay, fine. The profit sharing was to be revised from 1st April 2021 is 344. Actually, they have given in the problem the profit sharing ratio 543. But now they are changing profit sharing ratio to 344. Retrospective effect means 1st April 2021. Now whatever the profit we have and whatever the reserves and undistributed profits we have and whatever the revaluation profit we have, that is for all those things we have to consider 344 as profit sharing ratio. Okay, now look at out of 48,000, 4,000 is given bonus. What is the remaining profit? 44,000, and this 44,000 is distributed in 344 ratio. Look at profit and loss adjustment account debit to A capital account, 44,000 into 3 by 10. 44,000 into 3 by 10. How much? 12,000. 16,000 and 16,000. Clear, everybody? This is the first point. First point is very important in this problem. Remaining all we know. Goodwill was to be valued at 2 years purchase of the average profits of the preceding 5 years. Here goodwill valuation. Look at. The fixers were to be valued by, okay, first we take previous year profits. The fixers were to be valued by an independent valuer. The valuations arising out of the above agreement were already goodwill calculated. We thought we have to calculate goodwill. Tuch, they have calculated. Okay, no problem, let it be. Total 56,000 is the goodwill. Okay, out of 56,800, what is the share of goodwill of A? New ratio is how much? 3 by 10. So 3 by 10. 17,040. Just a minute. 56,800 into 3 by, sorry, 8, 11. 11, na? 3 by 11. 8 plus 3, 3 by 11. Okay. 56,800 into 3 by 11. It comes to 15,005. Just a minute. Okay, we check. And fixers 10,980. Fixers how much? 10,980. Fine. A provision of 2% was to be made for doubtful debts, and the remaining assets were to be taken at their book values. See how many assets are going to be changed. Fixers are taken at what value? 10,980. 10,980 means asset value increased na. Fixers account debit to revaluation account. Next, inventory value no change. Inventory value no change. Next, 2% provision is provided for trade receivables. 93,500 into 2%, it comes to 1870. Revaluation account debit to provision account. Remaining assets and liabilities are not changed at all. Okay, fine. B and C agreed as between themselves to continue the business, sharing profits in the ratio of 3:2. Now here we calculate gaining ratio. Decided to retain the fixers on the books at their revised value. Revised value means fixers, what is the revised value? 8,200. 8,200. All these things happened after retirement. All these things happened after retirement. Okay. And to increase the provision for doubtful debts to 6%. Already 2% is provided. Now they are increased it to 6%. Means extra 4% provision you have to create. This paragraph importance is after retirement. I repeat, after retirement of A, this paragraph will be applicable. Clear? Submit the journal entries necessary to give effect to the above arrangements and drop the capital account of partners after carrying out all adjusting entries as stated above. No need to prepare any balance sheet. But journal entries, look at. First, fixers increased na? Yes sir, fixers account debit. Yeah, they have written combined entry. Here observe, they have written combined entry. Actually, what is the entry we have to write? Fixers account debit to revaluation account. Next, revaluation account debit to provision for doubtful debts account. You can write separate entries, no problem. After that, the profit or loss is distributed among partners. But here they have written combined entry. You can check it. Next, this is capital account of A. Wait for some time. Now look at goodwill adjustment. Goodwill adjustment. 56,800 is the goodwill. Yes sir. 3 by 11. So total is 15,491. Total becomes 15,000. It is coming 15,490.909. So 15,491. This is shared between gaining partners. Who are the gaining partners? Check it. Calculate gaining ratio. See A, B, C. This calculation is very important. Old share is 3 by 11, 4 by 11, 4 by 11. New share. New share of B and C is given. Calculate the LCM and calculate how much share gained by other partners. See, total sacrifice 3 by 11. Gain of A 13 by 20, 55. C 2 by 55. So finally we take 13:2. Out of 15,491, 13 by 15. It comes 14,425. 13,425. 13,425 by B and C 2066. After that you can check it, partners capital account. All these entries are posted into partners capital account. Over. Finally, balance A capital account. A capital account, identify what is the amount due to him. In the problem they said A account is settled. In the problem they said after carrying out all adjusting entries as stated above. Okay, look at how much amount due to A. How much amount due to A? Total amount due to A is 1,43,669. But if you observe, do we have that much of amount in our bank? No. Cash, only cash amount is available 74,910. And that too in the problem they did not mention whether his account is settled or not. That's why the total amount due to A is transferred to his capital account. And last point, last paragraph adjustments they are doing after retirement of partner. Fixers value how much decreased? Fixers value how much we have to decrease now. Earlier it is increased to 10,980. 10,980 minus 8,200. Now we have to decrease it by 2,780 loss. And one more thing, provision for doubtful debts. Earlier 93,500 into 93,500 into total we have to provide 6%. It comes 5,610 minus earlier already we provided 1870. Now 3,740. What is the total loss? 2780. Total loss is 6520. Now this much of loss is borne by B and C in their new profit sharing ratio 3:2. Look at the last entry and finishing touch entry. See 3000 for this is for provision 3,740. 3,740. What about fixers? Fixers on the books at the revised value. Okay, sorry. Fixers on the books at the revised value. Na? Revised value is 10,980. It's my mistake. Sorry. Yes. 3,740 correct. And this 3,740 is loss. And it is distributed to B and C in their new profit sharing ratio 3:2. This is the problem. Okay. In this problem, two important points. First one and last one. These two things are very, very important. Now look at next. Yes. Practical question 1. This contains a joint life policy. Look at here. Yeah. Observe. So how do we solve joint life policy problems? Now we are in retirement now. When it comes to death, I will explain again. When it comes to retirement, now we are at retirement stage. Retirement of a partner. Retirement of a partner. First one. If first check the balance sheet. Check the balance sheet. Check the balance sheet. In the balance sheet, there is no concept of JLP. Suppose in the balance sheet, if there is no concept of JLP, in that case, it is treated as first method. First method means premium method. Whenever joint life policy is paid, we treat it as an expense and it is debited to the joint life policy premium account, and finally it is transferred to the P&L account. Means in our balance sheet you cannot find joint life policy. Okay, in that case, whenever you receive joint life policy, see, whenever a partner retires, we surrender the joint life policy. We surrender the joint life policy and we receive some amount from the insurance company. And whatever the amount you received from insurance company, this can be directly distributed to partners. Entry, cash or bank account debit to partners capital account. Or else, whatever the amount we received from insurance company, that can be credited to the revaluation account. That can be credited to the revaluation account as a gain. This is the first method. Now, I have seen balance sheet. The balance sheet contains joint life policy rupees 10,000. Joint life policy rupees 10,000. When joint life policy is showing in the balance sheet means, it is nothing but what? It is nothing but what? Joint life policy paid is treated as an asset. Joint life policy paid is treated as an asset. Now what we have to do? Generally, joint life policy in the balance sheet is shown at a surrender value. Shown at surrender value. And whenever you surrender the policy to the insurance company also pays surrender value. Now here the asset is, in that case the joint life policy account looks like this. Joint life policy account is showing 10,000. Joint life policy account is showing 10,000 balance, and we also received from insurance company 10,000 balance. Now the account gets closed. Means when the second method is followed, whatever the amount we received from insurance company as a surrender value, this can be distributed to partners only that amount exceeds opening balance of joint life policy account. Then only we distribute the amount. Otherwise, this account gets closed. No distribution of joint life policy. Over. Second method. Next, look at the balance sheet, and it is showing that JLP and JLP reserve. Maximum JLP reserve they will not ask. JLP is showing 10,000, so that JLP reserve also must show 10,000. This is nothing but reserve method. JLP reserve method. Third method. In that case, what we have to do? We have to open two accounts, JLP account and JLP reserve account. Okay. So in this case, JLP reserve is showing 10,000 balance. Right. JLP account as usual closed. Why? Because it is showing 10,000 balance and we received from insurance company 10,000. If you receive 11,000 rupees, in that case distribute extra 1,000 rupees to partners. Or else if you receive 15,000 rupees, distribute extra 15,000 rupees to partners. Whatever the amount you receive from insurance company, if it is exceeded 10,000 rupees, then distribute them to partners. Sir, if we receive less than that, no, we will not receive less than that. Why? Because surrender value is fixed. Is it clear? Yes. Sir, JLP account is closed now, sir. Yes. In that case, go to JLP reserve. Now, when JLP is not there, no need to maintain JLP reserve, na? Yes, sir. JLP reserve is showing which balance? Credit balance. Distribute this 10,000 to all partners in their profit sharing ratio, including retiring partner. This is the simplest method of solving problems on JLP. Now, we don't have much time to discuss in depth about JLP. Otherwise, I will discuss. Right? Keeping this concept in your mind, now come to practical question 1. Practical question 1. After completion of this practical question 1, next we move on to death of a partner. Now, on 31st March 2022, the balance sheet of Messrs. Ram, Rahul and Rohit sharing profits and losses in proportion to their capital stood as follows. Okay, fine. First one, capital account, Ram, Rahul, Rohit. Immediately what we have to do? Open partners capital accounts. Open partners capital accounts and post these items as opening balance. By balance brought down. Over. Sundry creditors 2 lakhs. If there is any change in the sundry creditors, then change it. Otherwise, take the same 2 lakhs to new balance sheet. After retirement of who is retiring? Ram is retiring. Next, land and building, machinery, closing stock, sundry debtors, cash and bank balances. Fine. Look at what next. On 31st March 2022, Ram desired to retire from the firm and the remaining partners decided to carry on. Okay, who are the retiring partners? Ram. So, who are the carrying partners? Continuing partners? Rahul and Rohit. Do remember, students, partnership problems they will ask in 3B and immediately 4A. If you take the whole partnership accounts as choice, that means you are going to lose marks from not only from partnership 3A, 4B. ICAI has designed the question paper in such a way that there is too much of complexity of choosing the question, which question can be left as choice. 3B, 4A partnership. 3A, 4B, either company accounts, final accounts of sole proprietorship or NPO or not for profit organization. Out of these three, they may ask in under 3A and 4B. 5C, company accounts. 6A, company accounts again. Is it clear? So the most dangerous question, you have to take it as choice. Identify after reading the question. After reading the question paper, you decide whether which question can be taken as choice. Okay, fine. Now continue. It was agreed to revalue the assets and liabilities on that date on the following basis. Look at first one. Land and building be appreciated by 30%. Land and building account debit to revaluation account. Machinery be depreciated by 20%. Revaluation account debit to machinery account. Closing stock be valued at 80,000. Closing stock is valued at 80,000. Look at the difference, whether it is increase or decrease. Closing stock earlier 1 lakh. Now it is valued at 80,000, means 20,000 loss. Revaluation account debit to closing stock account. Provision for doubtful debts is to be made at 5%. How much debtors we have? 2 lakhs. 2 lakhs into 5%, 10,000. So revaluation account debit to provision for doubtful debts account. Next, old credit balances of sundry creditors 10,000 be written off. Old credit balance. Old credit balances of sundry creditors 10,000 to be written off. Okay, this we discuss later. Next, joint life policy. Very, very important. Look at joint life policy of the partners. Surrendered and cash obtained 60,000. Look at, if you observe the balance sheet, will you find JLP? I have discussed now. Look at the balance sheet and identify whether JLP is given or not given. No, JLP is not given, sir. Means which method they have followed? Sir, first method, sir. When they have followed first method, means JLP premium paid is treated as expense. Now what we have to do? We have received some amount, na? Yes, sir. Directly you can transfer this amount to partners bank account debit to partners capital account distribute, or else this can be taken to the revaluation account as a gain. In this problem, what they have did? Look at. Yes, in this problem they have taken 60,000 to revaluation account, or else what you can do, you can transfer this 60,000 to partners capital accounts also, no problem at all, right? Next one, seventh point, goodwill of the entire firm we valued at 1,80,000. Total goodwill 1,80,000. Then what is Ram's share? Ram's share of the goodwill be adjusted in the accounts of Rahul and Rohit, whose share the future profits equally. Who share the future profits equally? Nothing but new profit sharing ratio. New profit sharing ratio is given 1:1. Old profit sharing ratio is profits and losses to their capital ratio. Capital. Here what are the capitals? 3:2, 2:1. Means this is old profit sharing ratio 3:2, 2:1. Now the new profit sharing ratio 1:1. Calculate gaining ratio. After calculating gaining ratio, 1,80,000 into what is Ram share? 3/5. Sorry, 3/6. 90,000. 90,000 is compensated by gaining partners. Okay. Next. Eighth point. The total capital of the firm is to be same as before retirement. Total capital of the firm is same as before retirement. Means before retirement of firm, how much is capital? 6 lakhs. Now this 6 lakhs is brought by Rahul and Rohit in their profit sharing ratio. What is their profit sharing ratio? 1:1. How much capital Rahul should bring? 3 lakhs. How much capital Rohit should bring? 3 lakhs. Now check how much capitals they have in our business. After giving all the adjustments, effect to do all adjustments, check how much capitals we have for Rahul and Rohit. Rahul and Rohit, their capitals must be 3 lakhs. If the existing capitals of Rahul and Rohit are less than 3 lakhs, they have to bring cash. If the existing capitals of Rahul and Rohit are more than 3 lakhs, then we will pay them back. Or else the excess amounts can be adjusted through current accounts also. If nothing is set, then they will bring the amount or they will take back their excess capital. If specifically said adjust the excess or short amount with current accounts, then we have to adjust with the current accounts. Next, individual capital to be in their profit sharing ratio means 1:1, 3 lakhs and 3 lakhs. Amount due to RAM. Now, how we are going to settle RAM account is to be settled as 50% on retirement. Calculate, suppose the amount due to RAM is 10 lakhs. After doing all the adjustments, amount due to RAM is 10 lakhs. Then 5 lakhs we are paying cash, and the remaining 5 lakhs is transferred to his loan account. And that amount we have to repay within 1 year, including interest. Okay, that interest part they have not mentioned, ignore. Initially what we do, 5 lakhs we pay cash and 5 lakhs we transfer to his loan account. With that, all adjustments completed. Prepare revaluation account, capital account of partners Rahul and Rohit, loan account of Ram, loan account. Finally, out of the total amount, 50% is paid, 50% loan account. Cash account and the balance sheet as on 1/4/2022 of Messrs. Rahul and Rohit. Now come to last point. Here they said old credit balance of sundry creditors 10,000 to be written off. Means we have to pay amount to creditors 10,000. That we are writing off. Means we need not to pay 10,000 to the creditors now. Why? Why? Because we need not to pay. They said they have given in the problem now. We have to follow accordingly. Why you need not to pay? You need not to bother. Write off 10,000 rupees. What is the entry for that? Sundry creditors account debit to revaluation account. Over. After giving effect to all these, final accounts completed. Clear everybody, right? So with this I am stopping retirement concept. Now I am moving on to death of a partner. Yes, now come to death of a partner. Very interesting here. In case of retirement, a partner can retire. Sometimes, see, a partner may be admitted in the business from the beginning of the year, from the beginning of the new financial year. At the same time, a partner may retire on the request of continuing partners. A partner may retire at the end of the year. Why? Because at the end of the year we prepare financial statements so that it is easy to us to settle the retiring partners amounts. Yes or no? In case of admission also, once the financial year is completed, then regarding previous year, all the books of accounts are completed, closed, so that fresh books of accounts are opened. Then you admit as a new partner. But in case of death, is it possible to say to a partner, hey partner, please go and die on at the end of the financial year or at the beginning of the financial year, or wait for some time, later on you leave? Is it possible? Not possible. Not possible. Why? Because we don't know. Death is certain, but what is the time of death? We don't know. At any point of time during the year, at any point of time, a partner may die. Whenever a partner died, then what is the accounting treatment? That is what we have to discuss. Whenever a partner died, then what is the accounting treatment? That we need to discuss now. Look at what are the adjustments we have to do when a partner died. Same revaluation of assets and liabilities, revaluation of assets and reassessment of liabilities. This is exactly similar to retirement of partner. Same memorandum revaluation concept also apply. Next one, distribution of reserves and accumulated profits, similar to retirement of partner. Next, computation of new profit sharing ratio and gaining ratio. Same. In case of retirement, the retiring partner will give his share to continuing partners. In case of death, already he died, his share of profit may be taken by the continuing partners. So gaining partners, the gaining partners will compensate goodwill to retiring partner, sorry, deceased partner. Next, valuation of goodwill. Yes, very important. In case of death of a partner, compulsorily they will ask valuation of goodwill concept. Whenever we get a problem on death of a partner, 99% chances are there they give you information to value goodwill, and this valuation of goodwill is sure. And accounting treatment, simple. The accounting treatment for goodwill is similar to retirement of a partner. What is the entry we have recorded at the time of retirement of a partner? Gaining partner capital account debit to retiring partner capital account. I repeat, gaining partner capital account debit to retiring partner capital account. Here also same. Here, gaining partner capital account debit to deceased partner capital account. In the place of retiring partner, what we write? Deceased partner capital account. Yes or no, students? Yes, sir. Next, adjustments of life policy. The difference between adjustment of life policy in case of retirement and death is, in case of retirement, we receive surrender value. I repeat, in case of in case of retirement, we receive surrender value. In case of death, we receive full policy value. Suppose the full policy value is 10 lakhs. On the date of death, we receive total 10 lakhs. Not on the date of death. When a partner died, we receive 10 lakhs. But when a partner retired, we will not receive full amount of policy. We receive the amount of surrender value as on the date of surrendering the policy. As on the date of surrendering the policy. Hope you are following. Yes, sir. Next. Same, JLP we have to check. If JLP is there in the balance sheet, suppose JLP is not there in the balance sheet, whatever the amount we receive, that is policy value, do remember, policy value that is distributed among partners are given credit to the revaluation account. Second one, JLP is there in the balance sheet. Here we have to discuss one thing. Look at, suppose in case of death, I am preparing JLP account. Look at, in case of death, the JLP is showing 1 lakh balance, 2 balance brought down. 2 balance brought down how much? 1 lakh. Now partner died. How much amount we are receiving by bank? 10 lakhs. What is the entry we record? Bank account debit to joint life policy account, 10 lakh. But in case of retirement, we receive surrender value. Surrender value is 99.99% equal to opening balance. In that case, there is no balance in the JLP account to distribute. Clear, students? Now what we have to do? Here in the JLP account, we have 9 lakh rupees surplus. 9 lakh rupees surplus. And this 9 lakh rupee is distributed to all partners, including deceased partner, because this 10 lakhs is received on the occasion of death of partner. That's why the remaining 9 lakhs is distributed among all partners, including deceased partner, in their profit sharing ratio, old profit sharing ratio. This is what we have to do. And in case of reserve method, what happens? Here we have JLP reserve. See, when JLP is showing 1 lakh balance, JLP reserve also shows how much balance? 1 lakh balance. JLP also shows 1 lakh rupee balance. Okay. On the death of partner, we received 10 lakhs. 9 lakh rupees distributed to all partners, including deceased partner, in their profit sharing ratio. Now, when JLP is not there, then what is the necessity of maintaining JLP reserve? This also distributed to all partners in their old profit sharing ratio. Over. Simple concept. Right now, simple trick. We can say it is simple trick. Now, yes, look at the next point. Next, this is the important point. Calculation of share of profit till the date of death. So what is the meaning of this? Suppose we have started the financial year. So we are in financial year 2024-25. We are in the financial year 2024 and 2025. Now we draw a timeline. This is a simple timeline. 1/4/2024, 31/3/2025. This is the financial year. Okay. Let us assume on 1st August 2024, partner died. Now what we have to do? Actually, we have to settle the account of deceased partner on exactly on 1st August 2024, but it is not possible. Now what we have to do? Now, in addition to them, one extra adjustment which we have to do is from 1st April 2024 to 1st August 2024, we did the business, we have earned some profit. Now what we have to do? We have to give share of profit of deceased partner till the date of death. Till the date of death, out of the profit earned by the business, we have to give share to him. Now the question comes, sir, will we prepare the financial statements on 1/8/2024? No, not possible. Generally, we prepare financial statements on what date? 31/3/2025. Is it possible to prepare financial statements on 1/8/2024? Not possible, sir. Then what we have to do? Now what we do is we take revenue, we know from 1st April 2024 to 1st August 2024. How many months? April, May, June, July. 4 months. For 4 months, how much revenue we generated, that is okay. But how much profit we earned, that we need, na? So that what we do is we take previous year profit. We take previous year profit. Previous year is what? 2023-24. Previous year is 2023-24. Previous year, let us assume we have earned 1,20,000 profit. Previous year profit. Now what we do is we take previous year profit as base. We assume the same amount of profit we earn in the financial year 2024-25. Now for how many months he is alive in the 2024-25? 4 months. Now what we do? This 1,20,000 we divide with the 12 months into 4 months. Per month we are calculating. 1,20,000 divided by 12. 10,000 per month profit we are assuming. And 4 months now, 40,000 profit. This is not share of deceased partner. Profit of firm. Profit of firm. Now what is the share of deceased partner? Share of profit is equal to profit is 40,000 into, let us assume the share of profit is 1/4 for simple calculation. Now what is his share of profit? 10,000. 10,000. This is how we calculate. This is called time basis. Time basis. Current year profit it is not possible to calculate. So that what I am doing, I am taking previous year profit. I am assuming that the profit has been earned evenly throughout the year. Evenly throughout the year. This is my assumption. Evenly throughout the year. This is my assumption. So that's why I am dividing 1,20,000 divided by 12. In the current year, he is alive for 4 months into 4. Total profit is 40,000. So what is his share of profit? This is the profit for 4 months into his share 1/4, 10,000. Now for this we have to write one entry. What is that entry? Profit and loss suspense account debit. This entry is very, very important, students. This entry is very, very important. Profit and loss suspense account debit 10,000 to deceased partner capital account. Deceased partner capital account 10,000. Yes. Now deceased partner capital account is credited with 10,000. Here we have profit and loss suspense account balance. Now this is shown on the assets side of balance sheet. Important point. P&L suspense account we have to show on the assets side of balance sheet. At the end of the year, P&L suspense account is transferred to the P&L appropriation account. This is the important factor. This is one condition. It is time basis. Now second one is turnover basis or sales basis. Turnover basis. Turnover basis. What is that, sir? We see how much turnover business made during these 4 months. We calculate how much turnover, sales na, it is easy to identify how much sales made during 4 months. Let us say 4 months sales are, suppose 1 lakh, sir. 4 months sales are 1 lakh. Okay. On this 1 lakh, what is the gross profit ratio or net profit ratio? So generally business will earn some rate of profit now. And this rate of profit we take previous year, based on previous year data, we take the rate of profit into rate by 100. Let us say 10%, that comes 10,000 rupees. And this is taken as profit. This is taken as profit. And what is share of profit? This profit belongs to all partners. Do remember. Now share of profit is equal to 10,000 into, let us say 1 by 4 is the share of profit of deceased partner. Now it comes 2,500. Same entry we record. Same entry we record. Profit and loss suspense account debit to deceased partner capital account. Yes. In case of death of partner, this is the exclusive point which we have to discuss. Share of calculation of share of profit of the deceased partner till the date of death. Hope you understood. Now go to problem. Except this remaining everything is simple, students. Similar to retirement of a partner. Similar to retirement of a partner. Next, adjustments of capital after death of a partner. This is also similar to retirement. Next, final settlement to the legal representatives of the deceased partner. In case of retirement, the amount due to the retiring partner is taken by him. But in case of death, he already died. Who will take the amount due to him? The legal representatives or executors. Is it clear? Yes. Students, if you are understanding this concept, please like the video and share it. Okay. Nobody is responding. Respond, students, respond. Now look at, we try to solve some problems on this concept. Problem number, tomorrow we have exam, so I hope your preparation is completed. Okay, tomorrow evening again we meet. Okay, tomorrow evening again we meet at question paper analysis once again. Okay, now look at illustration 1. The following was the balance sheet of Om and Co, in which XYZ were partners sharing profits and losses in the ratio of 1:2:2. And as on 31st March 2022, look at, okay, this is the closing date of the year. Mr. Z died on 31st December 2022. His account has to be settled under the following terms. Just a minute. Okay, now look at, Z died on 31st December 2022. How many months during the year? What is the financial year? 22, 23. 22, 23. For how many months he is alive during the year? For 9 months. 1st April to 31st December. For 9 months he is alive. Okay. His account has to be settled under the following terms. Okay, okay. Now I think it is audible, right? I hope this problem has some concept. That's why I am choosing. Initially, I am choosing easy problem to understand the concept. Later on, I am taking some tough problems. Okay, I hope you can understand. Now look at, trade payables 20,000, bank loan 50,000, general reserve. Yes. Irrespective of any information about general reserve, first, if you have any further information about general reserve, you transfer. Sorry, you distribute accordingly. Otherwise, you distribute straight away. To whom the general reserve is distributed? To partners X, Y, Z. Entry: general reserve account debit to X capital account, to Y capital account, to Z capital account. Next, capital balances. What we do? Open partners capital accounts and write down the opening balances. By balance brought down 40,000, 80,000 and 80,000. Next, building. Building is 1,20,000. Computers, inventories, trade receivables, cash at bank and investments 1 lakh. Fine. Now look at here, goodwill is to be calculated. I said already, whenever you get a problem on death of a partner, compulsorily they give you goodwill valuation. 99% chances are there, so be ready for that. Goodwill is to be calculated at the rate of 2 years purchase on the basis of average of 3 years profit and losses. Look at the profits and losses for the 3 years were detailed as below. These are the 3 years profits. First year 31st 3 2022, 21, 20. 30,000, 20,000, 10,000 loss. How much is the profit? If there are no adjustments, sometimes they may give you adjustments for these profits. Sometimes they may give you adjustments for these profits. You have to do adjustments. After that, you have to calculate average profit. But here, hope we don't have any adjustments. So straight away we can calculate goodwill. 30,000 plus 20,000, 50,000 minus loss 10,000. So that 40,000 is the total capital divided by 3 years. 40,000 divided by 3, we get 13,333 into, for how many years? As a rate of 2 years purchase into 2 years. So we get total 26,667 as our goodwill. Next one, profit for the period from 1/4/2022 to 31st December 2022 shall be ascertained proportionately on the basis of average profits and losses of the preceding 3 years. So here, previous year profits they are asking, take average profit. Based on that you calculate. Okay, fine. During the year ending on 31st December 2022, a car costing, this is very important students. This is the hard adjustment in the problem. Look at, during the year ending 31st 3 2022, last year. Now we are on which date? 31st December 2022. 31st March 2022 is the previous year. A car costing 40,000 was purchased on 1/4/2021 and debited to traveling expenses account. That means treating capital expenditure as revenue expenditure. Okay, account on which depreciation is to be calculated at 20%. Suppose if I have written, or if I have written this car in the previous year itself, 21/22, 21/22, then this 40,000 entry is there in the books of accounts. Yes sir, car account debit to cash or bank account. Okay, in that case I will provide 20% depreciation na? Yes sir, in that case P&L account shows how much depreciation? 8,000. P&L account shows how much depreciation? 8,000. But how much amount you debited to P&L account? Sir, 40,000 sir. By traveling expenses you debited na? Yes. Means excess debit given 32,000. Excess debit is given 32,000. Now what we have to do? 32,000 we have to take it back. Reverse. Now car we have to bring to the books of accounts. Car we have to bring to the books of accounts. How sir? Simple. Car account debit, how much? 32,000. Car account debit 32,000 to partner's capital account. Because this car we have to bring to the books of accounts. Yes sir. Earlier the profit is decreased na. So partner's capital accounts have less credit. Now that's why what we do? Now we increase partner's capital accounts. What is the entry we record? Car account debit to partner's capital account. Car account debit to partner's capital account. This is the adjustment we have to do. Look at. Just a minute. Yes. Partner's capital account debit to car account. How much? 32,000. In which ratio? In their profit sharing ratio. In their profit sharing ratio. Next one. This asset is to be brought into account at the depreciation value. We brought asset at 32,000 after a deduction of 20% depreciation in the last year. But now what they are saying? Now this asset we have to bring it to the books of accounts after deducting depreciation till 31st March. Because this asset is brought into books of accounts on 31st December. Sorry, 31st December. Now what we do? On 32,000 we simply calculate depreciation. How much? 20% into 9/12. 9/12. 4,800 depreciation we calculate. 32,000 asset brought into books. At the same time depreciation provided for 9 months. Entry revaluation account debit to depreciation account. Revaluation account debit to depreciation account. Okay, now look at. Just a minute. Revaluation account debit to depreciation account. And here if you observe the profits, previous year 2023 If the information is given like this, now this one, now it is the goodwill. But here, what is the information they are giving? They have treated capital expenditure as revenue expenditure, so that the profit on 31st March 2022 is affected now. The profit on 31st March 2022 is affected. Now what we have to do? Profit is increased. Earlier 30,000 is the profit. Now we have to increase it to 62,000, because 32,000 is different now. Increase it to 62,000 profit. 31/3/2022 the profit is increased to 62. Look at. Anyway, next year profit is 20. 62 plus 20, 82 minus 10, 81,000. Based on that we calculate depreciation. Sorry, goodwill. Look at. Average profit is how much? 72,000 divided by 3, 24,000. 24,000 into 2, 48,000. 48,000. Now here itself we calculate share of profit of Z also. They said take 3 years profits based on average profits and losses of preceding 3 years. Take 24,000. Take 24,000. 24,000 is the average profit. Out of that take 9 months profit. 24,000 is the total profit of the firm. Take 9 months profit. 24,000 into 9 by 12. How much? 18,000. Out of 18,000, what is the share of Z? What is the share of Z? Share of Z is 2 by 5 into 2 by 5. Now how much it comes? 7,200. For this 7,200, what is the entry we record? Profit and loss suspense account debit to Z capital account. Over. Next, other values of assets were agreed as follows. Inventory 16,000. Observe what is the inventory value here. Inventory value is 20,000. It is decreased to 16, means 4,000 loss. Okay. Building at 1,40,000. Building original value how much? 1,20,000. 1,40,000 means increased. Okay. Revaluation account debit to building account. Next, computers 50,000, investments 6,000. Trade receivables were considered good, means no need to provide any doubtful debts. Computer value increase or decrease? Computers earlier 80, now 50, decreased. Next, investments. Investments earlier 20,000, sorry, just a minute. Investments earlier 10,000, now it is decreased to 6,000, means 4,000 loss. Now accordingly you can solve this problem. Fine. What is the requirement? Calculate goodwill, already calculated. Z share of profit, already calculated. Prepare revaluation account. Okay. Assuming that other items of assets and liabilities remain the same. Fine. Prepare partners capital account and balance sheet of the firm of Om and Co. as on 31st December 2022. Right. Whatever we understood, now you can do it as a problem. Next, look at. I am taking one more important problem here from death of a partner. This is one type of problem. They give you balance sheet, additional information. You have to calculate, you have to prepare partners capital accounts, valuation of goodwill, and preparation of new balance sheet, all those adjustments. We have another type of problem. Just a minute. Another type of problem is okay, just a minute. Okay, look at this problem, illustration 5. Then after we see illustration 5. Dia, Ria and Kia are partners of Messrs. DRK Fabrics, sharing profits and losses in the ratio of 2:1:2. On 31st March 2022, their balance sheet was as under. On 31st March 2022, their balance sheet was as under. Look at capital accounts as usual, simple. General reserve distribute to partners. Trade payables, look at the adjustment. If there is no adjustment, straight away take so the same 60,000 in the new balance sheet. Land and building, furniture, yes. Joint life policy, observe carefully. Joint life policy. Here joint life policy is shown in the balance sheet, means which method they are following? Surrender value method. Surrender value method. So joint life policy paid is treated as asset. Inventory how much? 88,740. Trade receivable how much? 96,740. 750 and bank balance 1,14,510. Now Kia died on 30th September 2022. Means till 30th September 2022, whatever the profit earned by the business, out of that we have to give share to Kia. Look at the adjustments. The partnership deed provides as follows: that partners be allowed interest at 12% per annum on their capitals, but no interest be charged on drawings. Interest on capital is provided, but interest on drawings not provided. Upon the death of a partner, the goodwill of the firm be valued at 1 year purchase of average net profits after charging interest on capital for the 4 years at 31st March preceding the death of a partner. See, this is the death of a partner. Compulsorily, they give you a concept on valuation of goodwill. Next, the profits of the firm before charging interest on capitals were. Here they are saying these capitals are before charging interest. Now what we have to do, from each year profit, we have to deduct interest on capital. Okay. Average capital during the preceding 4 years may be assumed as 3 lakh. Now we are on what date? 30th September 2022. These profits are relating to previous 4 years. To calculate interest on capital, we need to know in the year 2018-19 how much capital we have, 19-20, 20-21, 21-22, how much capital we have. Is it clear? But that's why, to avoid all those confusions, they said on an average they have 3 lakh rupee capital during the 4 years. So on these 3 lakhs, we straight away calculate 12% interest. 3 lakhs into 12% interest, 36,000. What we can do is, first we calculate average profit. Out of the average profit, here straight away you can deduct 36,000 interest on capital. Next, profits till the date of death be ascertained on the basis of average profit of previous 4 years. Profits till the date of death. Now what we do, previous 4 years profits are averaged. Multiply with the number of months he is alive, Kia alive in the business. How many months Kia is alive? 1st April, May, June, July, August, September. For 6 months she is alive. So average profit into 6 by 12. We get business profit. Out of that, what is Kia share? Kia share is 2 by 5. 2 by 5. Is it clear? This is how we calculate profit. Next, upon the death of a partner, she is to be credited with her share of profit. Okay, calculated. Interest on capital. Okay, we provide. And etc. calculated till the date of death. If you observe, till 30th September 2022, we have to give interest on capital also. We have to provide interest on capital also. Fine. Next one. After the death of Kia, 2 lakh was received from insurance company against joint life policy. If you observe, here joint life policy is shown at 60,000, but we received 2 lakhs. 2 lakhs minus 60,000, remaining 1,40,000 is distributed to all partners. Land and building was appreciated by 20%, revaluation account debit to land and building account. Furniture to be depreciated by 10%, revaluation to furniture. Inventory to be revalued at 80. What is the inventory value originally? 88,740. Now they revalued at 80. So 8,740 decrease. Bad debts amounted 1,760. Bad debts. So permanently reduction. Revaluation account debit to trade receivables 1,760. Next, amount payable to Kia was paid in cash. Finally, whatever the amount due to Kia was paid in cash. Okay, now you are required to prepare revaluation account, partners capital accounts, and balance as on 30th September, balance sheet as on 30th September 2022, assuming that other assets and liabilities remaining the same. Is it clear, students? Yes. Look at the revaluation account. Simple. Only you have to make the changes. Finally, what is the amount due to Kia? 2,79,800. Okay, here joint life policy is distributed among partners. Look at 1,40,000. And sometimes they may ask, only prepare Kia capital account and executors of Kia account. In that case, and one more important thing, interest on capital. What is Kia's capital? 70,000. Opening capital 70,000 into what is the rate of interest? 12%, 12 by 100. She is alive for 6 months, 6 by 12. 70,000 into 12% into 6 by 12. This comes 4,200. And in the balance sheet, and look at share of profit. Share of profit 27,600 share of profit. Clear? Look at average capital 162 plus 199 plus 187 plus 196. This is the average profit 7 by 4 minus 36,000. 1,50,000 is the average capital into 6 months, 6 by 12. 75,000. Out of that, her share of profit is 2 by 5. Yeah, just a minute. 1,86,000. 1,86,000. Okay. Okay. How much it is? 1,50,000 average profit minus we have to deduct interest on capital of all partners. What is the interest on capital of all partners? Observe here. Yeah, this is goodwill average profit same 7,44,000. 1,86,000 is the average profit. From that we deduct interest on capital 36,000. What is the average capital here? 1,50,000. 1,50,000 multi 1 year profit na. Goodwill is calculated at 1 year purchase. So 1,50,000. What is Kia share? 2 by 5. 60,000. This is contributed by gaining partners. Look at who are the gaining partners. Calculate gaining partners. Okay, journal entry. This is a journal entry. Okay. Now Kia share of profit. Look at total profit 1,86,000. Out of that we take 6 months profit 93,000. Till the date of death 30th September. 30th September. How much interest on capital is provided? We have to provide interest on capital. Na? Total capital is how much? Tell me. Total capital is 1.5 lakh plus 1,80,000 plus 70,000. 4 lakhs na? 4 lakhs into 12% into 6 by 12. For 6 months is calculated 24,000. 24,000. Now look at what is the remaining profit? 69,000. Out of 69,000, 2 by 4. Sorry, 2 by 5. 27,600. Next. That's it. Simple problem. Okay. This type of problem. There may be chances of getting this type of problem in the exam. Clear? So with this, I am closing death of a partner. But do remember students, in case of death of a partner, compulsorily they will ask goodwill adjustment. And sometimes they may ask prepare executors of deceased partner account. Nothing but first calculate. In that case, what we have to do, first calculate amount due to deceased partner. After that, transfer the total amount to executors account. From there, the executors account, from there the amount may be transferred to executors loan account. Okay, now look at. Now come to dissolution of partnership firm. Dissolution of partnership firm. This is also very important chapter. This time we may expect a problem from dissolution of partnership firm. We may expect a problem from this chapter. Look at dissolution of partnership firm means what? The partnership business is completely closed. Now the relationship between all partners comes to an end and the business is closed. When the business is closed, then how do we close the books of accounts? See, when business is opened, the books of accounts also opened. When the business is closed, then the books of accounts also closed. Yes or no? How do we close the books of accounts? And how do we settle the outside liabilities? And how do we repay the capital amounts due to the partners? This is what we learn in this chapter, dissolution of partnership firm. Okay, in case of dissolution of partnership firm, what we have to do, we have to completely close all the books of accounts. Okay, now look at what is the accounting treatment we have to follow. First, look at the consequences of dissolution of partnership firm. First, the books of accounts are closed. Fine. The assets of the firm, including goodwill, are realized first. Out of the proceeds of realization, we repay amount to the outside liabilities first. Okay, look at the application of the amount. First, realization expenses. Fine. Payment of outside liabilities. Next, repayment of partners' loans. If any loan taken, see, loan taken from partner is not an outside liability. Okay. Next, repayment of partner's capital balance. If still has any surplus amount, then that is also distributed to partners in their profit sharing ratio. This is what this happens after dissolution of partnership firm. Next, look at accounting for dissolution of partnership firm. Whenever you get a problem on dissolution of partnership firm, then prepare these many accounts. 1. Realization account. Once the partnership business is closed, then we start realizing the assets and we start repaying the amounts due to outside liabilities. During this process of realization, if we get any profit or loss, that is transferred to the partners. To know whether we get profit or loss on the realization process, we are preparing a new account called realization account. In case of admission, retirement and death, we have prepared revaluation account to know the profit or loss on revaluation process. And here we prepare realization account to know profit or loss on realization of assets and repayment of liabilities. And this profit or loss on realization is distributed to partners. Now look at, first we prepare realization account. Next, loan taken from partner account is prepared if required. Next, loan given to partner account is prepared separately. Next, partners capital accounts and cash or bank account. Most and important, we prepare realization account most of the times, and partners capital accounts and cash or bank account we prepare. Now look at closing procedure. What we do? Now they give you balance sheet. They give you balance sheet and they tell you these many assets are realized and this much of liabilities paid, and finally partners account settled. Now what we have to do? First, we have to empty the balance sheet. From balance sheet, first come to assets side. All assets are transferred to realization account because asset account we have to close now. All ledger accounts must be closed. Whatever the ledger accounts contains in the balance sheet, asset side, all the ledger accounts of assets or asset account balances are transferred to the realization account. Whenever you are transferring assets, all assets to the realization account, do remember one thing. First, asset account balances we have to transfer to the realization account at their book value. Second, cash account balance or bank account balance not transferred to the realization account. Third, if any partner capital account is showing debit balance or if any partner's current account is showing debit balance, then don't transfer. Next, if any advance given to the partner account is showing on the asset side of balance sheet, then don't transfer. And if any fictitious assets or any debit balance in the profit and loss account is showing on the asset side of balance sheet, don't transfer. Except these accounts, remaining all accounts are transferred to the, including goodwill. Goodwill also can be transferred to the realization account at their book values. Because now let us assume building I have in the books at 1 lakh. To close the building account, what I have to do? Credit building with 1 lakh, then only building account closed now. That's why the assets are transferred at their book values. And one more important thing, if you have any provisions against any fixed assets or current assets, these provisions are transferred separately. Means, suppose if we have provision for doubtful debts 1000 rupees, debtors 10,000. Whenever you are transferring debtors account to realization account, transfer at 10,000. Provision 1000 separately. Okay, next. Or suppose if you have any provision for depreciation on any asset, building, suppose on building we have provision for depreciation. Building you transfer at 1 lakh. Provision separately you transfer because provision shows debit balance. Right. Next. Transfer all liabilities to outsiders and provisions against assets. Liability shows credit balance na, transfer debit. Liabilities account debit to realization account. Which liabilities? Only outside liabilities, not liabilities to partners. Whenever you are transferring liabilities to realization account, do remember, don't transfer capital account balances. Don't transfer any loan taken from partner account. And don't transfer any current account balances also. Remaining all accounts you can transfer. Next, on realization of assets. Now what we do? We start realizing the assets. Entry, bank account debit to realization. Whenever you are realizing the assets, do remember one thing. One, assets can be realized in cash. In that case, entry, bank account debit to realization account. Second, assets can be taken by the partner. Sometimes assets may be taken by the partner. In that case, what is the entry we record? Realization account debit. Oh, once again, partner's capital account debit to realization account. If it is sold, then what is the entry? Bank account debit to realization. If it is taken by partners, then what is the entry? Partners capital account debit to realization. Sometimes any asset may be given to liability holders. I repeat, sometimes any asset may be given to liability holders to settle the liability. In that case, no need to record any separate entry. Why? Because in our books, liability account closed. In our books, asset account also closed. Now what we are doing? Just we are physically handovering the asset to liability holders. In that case, no need to record any separate entry. Check in the problem that whether any asset is released in cash, or any asset is taken by the partner, or any asset is given to liability holders to settle their accounts. Is it clear? Based on that, we have to write the entry. On realization of asset, if it is realized, cash or bank account debit to realization. If partner taken, partner's capital account debit to realization. On making payments of external liability, and do more. At the time of making payment to external liabilities, do remember one thing. First one, external liabilities paid by the business. Entry, realization account debit to cash or bank account. If you receive any discount at the time of making payment to outside liabilities, don't consider discount. Whatever the amount you are paying, record entry for that. Don't write the entry realization account debit to cash account to discount received account. No. Write down the actual amount paid. Second, if any liability is agreed to pay by the partner, suppose there is one liability called loan from spouse of partner. Loan from spouse of a partner. In that case, what is the entry we have to write? This loan is agreed. See, loan from spouse of a partner is outside liability. It is not internal liability. It is outside liability. Now, this liability is agreed by the partner. Yes, part. In that case, what is the entry we record? Realization account debit to partner's capital account. Realization account debit to partner's capital account. These are the points we have to remember at the time of making payment to them. And whenever we are paying liability by giving an asset, we are settling the liability by giving an asset. Give the asset. That's it. No need to record any entry. Next, expenses on dissolution of firm. At the time of dissolution, we actually employ one person. Okay, liquidator, official liquidator or liquidator, whoever it may be. He will look after the proceedings of realization. In that case, what is the entry we record? Realization account debit to cash or bank account. If the realization expense is paid by the partner, then realization account debit to partner's capital account. Next one. Now look at unrecorded asset sold or taken over by any partner. Suppose at the time of realization of assets, if you find any unrecorded asset, in that case what we have to do? You need not to record any entry for that. But in case of retirement or death or admission, we have recorded entry for unrecorded asset. But here you need not to record. Straight away, what is the entry we record? Cash or bank account debit if it is realized. If it is taken by partner, partner capital account debit to realization account. Over. Next, if any unrecorded liability is paid, no need to record any entry, separate entry for recognizing liability in the books of accounts. Why? We are closing the books of accounts now. What is the necessity of recording liability again? So straight away pay the liability. Entry realization account debit to cash or bank account. After doing adjustments till 9th one, after doing all these transactions, after recording all these transactions, now what we have to do? Our realization account shows either profit or loss. Realization account credit more than debit, then it is realization profit. If realization account debit side is more than credit, then it is realization loss. It is distributed to the partners. If it is profit, realization account debit to partners capital account. If it is loss, partners capital account debit to realization account. Now the realization account looks like this. Clear everybody? Right. Now settlement of partners accounts. After completion of realization procedure, how partners capital accounts are closed. Now, after making payment to all outside liabilities, now partners loan is repaid. Entry. Partners loan account debit to cash or bank account. Suppose if any partner capital account is showing debit balance, I repeat, if any partner capital account, suppose A is a partner, his capital account showing debit balance, whereas his loan account showing credit balance, because means the firm borrowed amount from him. In that case, you need not to pay amount to the A. Simply adjust the loan account against the capital, because loan firm has to pay loan amount to A has to pay capital amount to firm. Adjust it. Okay. Next one. Transfer of current account balance to capital account. If suppose if partners are maintaining fixed capital method, in that case they maintain two accounts now, capital account and current account. In that case, current account balance is closed by transferring it to partners capital account. Next, transfer of current account debit balances. Any debit balance is there, same, transfer to partners capital account. Next, transfer of any reserves and accumulated profits, straight away transfer to the partners capital account. In case of admission, retirement, death, what we did, all the reserves and accumulated profits are transferred to the partners capital account. Next, transfer of any accumulated losses, here also same, losses shows debit balance na, transfer partners capital account debit to losses account. Next, if any partner capital account shows a debit balance, after doing all the adjustments, suppose there are three partners A, B, C, after doing all the adjustments, suppose C capital account is showing debit balance. Generally capital account shows which balance? Credit balance. If any partner capital account is showing debit balance, means he has to bring that much of amount to the firm, he has to pay that much of amount to the firm. When he is in a position, to pay that amount, then record the entry, cash or bank account debit to partners, it is not a particular partner capital account, the partner whose account is showing debit balance. Okay. Or else suppose if any partner capital account is showing debit balance, he is unable to bring that amount to the firm, then he is said to be insolvent. In that case, the insolvent partner's loss, whatever the capital deficiency, this is called capital deficiency, whatever the capital deficiency is there, that is borne by solvent partners, that we discuss in case of insolvency. Okay, now come to next point, payment of credit balance after final balancing. Finally, whatever the amount due to all partners, settle. In that case, what is the entry we record? Partners capital account debit to cash or bank account. With this, partnership books of accounts closed and dissolution also completed. Now look at, based on this, we try to solve one simple problem. Not simple problem, actual problem. Observe. See, look at, X, Y and Z are partners of the firm XYZ and Co, sharing profits and losses in the ratio of 4:3:2. X, Y and Z are partners of the firm XYZ and Co, sharing profits and losses in the ratio of 4:3:2. Following is the balance sheet of the firm as on 31st March 22. Balance sheet as on 31st March 2022. Look at, fixed assets, stock in trade, sundry debtors, cash in hand. Partners capitals XYZ 4 lakh, 3 lakh, 2 lakh. General reserve, sundry creditors. Now you people tell me, out of the assets, which assets are transferred to realization account? Fixed assets transferred, sundry stock in trade, sundry debtors. These three are transferred to the realization account. Entry, realization account debit to fixed assets, to stock in trade, to sundry debtors. Book values. Cash in hand, open cash account, debit balance, to balance brought down 10,000. Now here partners capital accounts are there. Open partners capital accounts show these balances as credit balances, by balance brought down. Now general reserve, immediately distribute to partners. General reserve account debit to XYZ capital account in their old profit sharing ratio. Next, sundry creditors. Sundry creditors transfer to realization account. Entry, sundry creditors account debit to realization account. Next, partners of the firm decided to dissolve the firm on the above said date. Okay, fine. Fixed assets realized 5,20,000 and book debts 4,40,000. Stocks were valued at 2,50,000 and it was taken over by partner. Means, and one more thing we have to remember is here total how many assets we have. Fixed assets, stock in trade, sundry debtors. We have to see that whether all assets are realized or not. We have to see that whether all assets are realized or not. If it is a tangible asset, we have to check whether all assets are realized or not. If any particular asset is not given, whether it is realized or not, in that case we assume that this particular asset is realized in cash at book value. This particular asset is realized in cash at book value. When it comes to intangible asset, suppose in the books of accounts we have goodwill first transferred to the realization account. In the problem they did not mention whether goodwill is realized or not. In that case we assume that goodwill is not realized, its realizable value is 0. Suppose patents are there, patents first transferred to the realization account. Next, it is not given whether patents are realized or not. What we assume? We assume that patents are not realized because it is intangible asset. This is the assumption we have to take. But in case of tangible assets, we have to see that whether all assets are realized. No, sir. In that case, this particular tangible asset is realized at book value. That is the assumption we have to take. Now here you observe fixed assets realized, book debts nothing but sundry debtors realized. Now stock is taken by Y. What is the entry we record for fixed assets realization and book debts realization? Bank account, cash or bank account debit to realization account. And what is the entry here we record? Who is taking? Y is taking. Y capital account debit to realization account 2,50,000. Next, creditors allowed discount 5%. I already said if any discount allowed by creditors, don't consider. What is the amount payable to creditors? 3,20,000. Minus how much discount they are giving? 5%. So how much amount we have to pay to them? 3,04,000. Pay 3,04,000 straight away. What is the entry we record? Realization account debit to bank account, cash or bank account. Over. That's it. Next, and the expenses of realization amounted to 600. What is the entry for expenses of realization? Realization account debit to cash or bank account 6,000. Over. Prepare realization account, partners capital account and cash account. At the end, after completion of realization procedure, after repayment of partners loans, all those things. Now if you observe partners capital accounts and cash account, whatever the amount due to the partners, all partners, that should be matched with the cash balance which you have finally. I repeat, if you balance partners capital accounts, you can come to know that how much amount due to them. This must be equal or this must be tallied with the cash balance which you have. This must be tallied with the cash balance which you have. Is it clear, students? Yes, sir. Next. So this is how we solve the problem. Look at realization account. Yes, the profit or loss. If credit is more than debit, it is profit. If debit is more than credit, it is loss. Next, partners capital account. Observe here. These are the final balances of partners. These are the final balances of our final amounts payable to the partners. This must be equal with the cash balance. Before recording the final payment entry, the cash balance or cash account balance must be equal to partners capital account balance. Is it clear, students? Yes, sir. Now look at, this is the simple problem. Now look at, we try to solve another problem. Here I will discuss when a partner becomes insolvent. When a partner becomes insolvent, sometimes we get this concept also in the dissolution. Insolvency of a partner. Previously I have discussed that after doing all the adjustments, if any partner capital account is showing debit balance, means he has to bring that much of capital to the firm. If he becomes insolvent, in that case he is unable to bring that amount. So whatever the amount of capital not able to bring by the partner, this particular amount is called capital deficiency. This particular amount is called capital deficiency. And who has to bear this capital deficiency? Unless this short capital brought by either in that particular partner or other partners, it is not possible to settle the remaining partners capital accounts. Why? Already just now I told you, before repayment of capitals due to the partners, check that partners capital account balances must be equal with the cash account balance. But here one partner capital account is showing debit balance and other partners capital accounts are showing credit balance. Means this partner whose capital account showing debit balance, he has to bring that amount. In that case, the amount will be matched. Otherwise, the cash balance is not equal to the amount due, final amount due to the other partners. Now, who has to bear this capital deficiency? The capital deficiency may be borne by other partners in any ratio. In any ratio, that may be in their profit sharing ratio, or that may be in their other any particular agreed ratio, whatever it may be. That depends on partnership deed first of all, or the mutual agreement between the remaining partners or solvent partners. If nothing is happened, then we have to follow one rule. What is that rule, sir? Garner versus Murray rule. Garner versus Murray rule. This rule we have to follow. What this rule says? This rule says that whatever the capital deficiency we have, capital deficiency of insolvent partner, that is borne by the solvent partners in their capital ratio. Which ratio? Capital ratio, not in regular profit sharing ratio, because it is capital loss. Capital loss we have to bear in their capital ratio. Here the problem comes. Sir, capital ratio means what? Capital ratio means they may follow fixed capital or they may follow fluctuating capital. If partners follows fixed capital method, then we prepare fixed capital account and current account. Whatever the capital account balances we have, those capital account balances are taken as capital ratio. But in case of fluctuating capital method, what we do? After doing all adjustments, I repeat, after doing all adjustments, but before distribution of realization profit or loss, after doing all adjustments means if partnership deed provides remuneration, salary or interest on capital, interest on drawings, any distribution of general reserves balances, all those things. After distribution of all those things, but before distribution of realization profit or loss, whatever the capital balances we have, that capital balances are taken as capital ratio. That capital balances are taken as capital ratio. Do remember, students. Is it clear? Yes, sir. Next point, what he is saying, the solvent partners should bring in cash equal to their respective shares of the loss on realization. One more condition he is saying. Suppose in the during the dissolution process, if we have any realization loss, I repeat, if we have any realization loss, that particular realization loss, other partners should bring in cash. I repeat, during the process of realization or after completion of all the realization process, if realization account shows any loss, that particular loss amount, all the partners, including insolvent partner, as much of as possible, they have to contribute in cash. Suppose realization loss distributed to partners A, B, C, 10,000, 10,000, 10,000. This is the realization loss distributed. C became insolvent. Means C is unable to bring the amount now. Yes. Remaining two partners A and B, they have to contribute 10,000, 10,000 realization loss in cash. This is just a notional entry. This is just a notional entry which we record. Okay, next. Based on this concept, now we try to solve one problem. Insolvency of a partner. Insolvency of a partner. This is not this one. Yeah, look at illustration 2. Look at illustration 2. Illustration 2. P, Q and R were partners sharing profits and losses in the ratio of 3:2:1. No partnership salary or interest on capital being allowed. Means no partner is eligible to take interest on capital or any salaries. Their balance sheet on 30th June 2022 is as follows. Their balance sheet on 30th June 2022 is as follows. Look at fixed capital. They are following which capital? Fixed capital. P capital, Q capital, R capital. Prepare partners capital account. Opening balances by balance brought down. And current accounts. Open current accounts also. P account showing credit balances by balance brought down. Whereas if you observe our current account is showing debit balance, means to balance brought down. Next one, loan from P. P borrowed, the firm borrowed amount from P. Open a separate account, loan from P. Next one, trade creditors. Trade creditors transfer to realization account. Creditors account debit to realization account. Next one, assets side come. Fixed assets. Trademark, freehold property, plant and equipment, motor vehicle. These are the fixed assets. Transfer to P&L, sorry, realization account. Entry. Realization account debit to assets account. Here transfer value assets at book values. Observe here trademark is intangible asset. Check in the problem that whether the intangible assets are realized or not. Current assets, stock 3900, trade debtors 2000, provision 100. Do remember, provision is separate. Provision is separately transferred. Now what is the entry for this? Realization account debit to stock account 3900. We write total entry, fixed assets and current assets. Realization account debit to stock account 3900, debtors 2000, cash at bank separately open the account. And miscellaneous losses, don't transfer these miscellaneous losses. So finally, how many accounts we transfer? Trademark, freehold property, plant and machinery, motor vehicle, stock, debtors. But debtors are transferred at 2000 rupees, not at 1900. Now what we do? Our current account anyway we have opened. Profit and loss account, which balance it is? Debit balance. Accumulated loss. Distribute to partners. Entry. Profit and loss account already showing debit balance na? Yes sir. Partners capital account debit to profit and loss account. Or else we can do one thing. Here current account balances are there na? Generally, if we get profit, to which account we transfer? Current account. They are maintaining two accounts, capital and current. And this accumulated loss first transfer to current account. This accumulated loss of 12,000 transfer to current account first. Now balance current accounts. Final balances of current accounts transfer to capital account. This procedure also we can follow. Next. On 1st July 2022, the partnership was dissolved. Fine. Motor vehicle was taken over by Q. Immediately, what is the entry we record? Q capital account debit to motor vehicle account at a value of 500. Okay, but no cash passed specifically in respect of this transaction. He has not paid any cash. So okay, so that what is the entry we record? Q capital account debit to realization account. Next, sale of other assets realized the following amounts. Don't forget to compare whether assets shown in the balance sheet are realized or not. Look at motor vehicle anyway realized. Total how many assets we have? Trademarks, freehold property, plant and machinery, motor vehicle 4, stock, debtors. Total 6. Out of them motor vehicle realized. Next, trademarks realized nil. They said freehold property realized, plant and machinery, stock and trade debtors. Total amount realized this much: 7,000, 5,000, 3,000 and 1,600. This much of amount realized. Entry, bank account debit to realization account. Over. Next, total creditors were paid 11,700 in full settlement of their debts. What is the amount due to total creditors? 12,400. What about remaining difference? 300 plus 400. 700 difference is nothing but discount received. No need to write separate entry for discount received. Finally, what is the entry we record? Realization account debit to bank. Next, the cost of dissolution amounted to 1,500. Nothing but realization expenses. Entry, realization expenses account debit to bank account. The loan from P was repaid. Entry. Loan from P account debit to bank account. P and Q were both fully solvent and able to bring in any cash required, but R was forced into bankruptcy. R was forced into bankruptcy. Here, insolvent. There are two situations. One, all partners insolvent. All partners insolvent. Two, only one or more partners insolvent, but not all partners. In this situation, we have three partners. Three partners, P, Q, R. Who became insolvent? R. Not all partners. Na? Yes, insolvent. When a person becomes insolvent, a partner becomes insolvent, whatever the amount of deficiency, capital deficiency is there, that is borne by remaining solvent partners. Who are the solvent partners? P and Q. What ratio? Capital ratio. Already capital ratio is given now, 20,000 and 20,000. 2 is to 2, 1 is to 1. 1 is to 1. Fine. Finally, and was only able to bring 1/3 of the amount due. Are bankrupt, but how much amount he is able to bring? 1/3. 1/3. Required. Cash and bank account we have to prepare. Realization account we have to prepare. Partners capital account we have to prepare after transferring current account balances. That's it. This is the requirement. Already I have explained whole problem. Now only the thing is answer. Right? Now look at. Here check whether realization account has profit or loss. If realization account has loss, that loss should brought by the partners in cash. In which situation? Insolvency situation. That is a point we have to consider. Look at. Here we have a loss. How much loss? Total 51,000 rupees loss. Anyway, R is not in a position to bring the loss, 8,500. Then who has to bring? P and Q. Look at whether this entry has been passed or not. First, share this realization loss. Yes, this is the sharing of realization loss. And the same amount is brought by partners. Look at 25,500 and 17,000. We need to check this. Finally, what is the amount due from R? For that, balance R capital account 10,000 plus 300. Sorry, 10,000. Debit side, look at 2,400 plus 8,500. Total 10,900. Minus credit side 10,000. So how much amount R should bring? 900. Now he is not in a position to bring 900 now, but he is in a position to bring 1/3 amount. How much? 300. Write down the entry for 300. Bank account debit to R capital 300. Now finally how much amount he is unable to bring? 600 rupees. And that this 600 becomes capital deficiency. This is borne by P and Q in which ratio? Equal. 1 is to 1. Means 300 by Q, P, 300 by Q. Entry. R capital account debit. Sorry, P and Q capital account debit to R capital account. P and Q capital account debit, look at 600 by R capital account. Sorry, by P and Q capital account 600. With this, R capital account gets closed. With this, R capital account gets closed. Observe carefully. After closing R account only, I repeat, after closing insolvent partner capital account. I repeat, after closing insolvent partner capital account, we have to close remaining partners capital accounts. We have to close remaining partners capital accounts. Do remember. Finally, remaining partners capital account balances should be matched with the cash balance which we have. Clear? This is insolvency of partner. You may ask, sir, in case if all partners becomes insolvent, then what we have to do? All partners become insolvent means we are unable to pay the amount due to creditors. If we can pay amount due to creditors, then it is okay. But when all partners become insolvent, we are unable to pay amount due to the creditors. In that case, don't transfer creditor account balance to realization account. Realization account. In that case, what is the approach we have to follow? Look at insolvency of all partners. When all partners become insolvent, don't transfer assets to realization account, but don't transfer creditors or outside liabilities to realization account. We have to deal creditors or outside liabilities separately. Don't transfer. Now, realization of assets, transfer assets to realization completed. Don't transfer liabilities. Instead of transferring liabilities, open liability account separately. Now start realizing the assets one by one. Out of the proceeds of realization, first repay as much as amount possible to creditors. As much possible amount due to creditors. For that, what is the entry we record? Creditors account debit. Creditors account debit to bank account. Suppose amount due to creditors is 1 lakh, but with us we have only 50,000 rupees. What about remaining 50,000? We are unable to pay, na? Yes, sir. So 50,000 we transfer to deficiency account. Means this much of 50,000 we are unable to pay. This much of 50,000 we are unable to pay. Transfer this amount to deficiency account. Finally, balance all partners' capital accounts. All partners shows debit balances only. Why? Because all partners became insolvent now. All partners capital account shows debit balances. Now, whatever the deficiency we have, credit 50,000, transfer to partners capital account. Here deficiency credit, their partners capital account debit, transfer. Deficiency account debit to partners capital account. Automatically all accounts gets completed. This is the concept of insolvency of all partners. Now we go to another important concept, that is piecemeal payments or piecemeal distribution. This time we may expect this type of question. Why? Because in the first attempt, June 2024, they have asked a question on piecemeal payments. After that, September 2024 and January 2025, they have not asked a question from this piecemeal payments or distribution. This time we are expecting a question from piecemeal payments or distribution. Look at, observe carefully. Till now, whatever the dissolution procedure we have observed, I repeat, till now, whatever the dissolution procedure we have observed, that we assumed that on a single day, all assets realized, all amounts due to outside liabilities are paid, realization expenses paid, and partners capital accounts also completed. Total dissolution process happened in one day. That is what we observed now, previous problems. But practically it will not happen. Practically what happens? Okay, we resolved that from 31st March 2025. I repeat, we resolved that from 31st March 2025 we are closing the business. Okay, stop all business operations. Stop all business operations. Okay, sir. From 1/4/2025, from 1/4/2025, you start the proceedings of realization of assets. Clear? All assets of the business, it is not possible to realize on a single day. These assets are realized one by one. Now what is here? The assumption is whenever the assets realized, we start distributing that amount to first realization expenses, after that amounts due to outside liabilities. After repayment of amount due to outside liabilities and partners loans, all those things, now the amount due to partners. Now come to the amount due to partners. Here the amount available is less, but whereas amount payable to partners are more. I repeat, here in our hand amount distributable amount is less, whereas amount due to partners are more. In this scenario, how do you deal? How do you deal with this scenario? I repeat, from 1/4/2025, we start realizing one by one asset. Whenever asset realized, we distribute amount due to the outsiders, or amount of after distribution of amount due to the outsiders as per a particular ratio or as per the preference. Some secured creditors are there, unsecured creditors are there. To the secured creditors we repay the amount first, to the unsecured creditors we repay the amount proportionately or as a percentage, some percentage. After payment to creditors, remaining amount payable to partners loans. Okay, partners loans also repaid. Now the next preference is to partners capital account. Amount due to partners capital account is more, but the amount available to distribute is less. How do you deal with this scenario? You may ask, sir, why are you thinking, sir? Whatever the amount you have, na, that amount distribute to partners. How do you distribute? There are three partners A, B, C. A is asking, sir, please give me that amount, sir. I have to go to some Dubai, or I have to go to some US, sir, for a trip. Anyway, business is closed now, sir. Give me that amount. I will go to some pleasure trip, sir. Huh? Okay. B is asking, sir, please give that amount to me because business is closed, sir. I have to pay college fees or school fees for my children. C is asking, sir, please give me that amount to me because some medical emergency, sir. No, it is not possible. Okay, the available amount, if all partners agree, practically, if all partners agree, okay, the amount is shared by us in this manner. Okay, you can distribute, no disputes. Distribute, no disputes. But when it comes to accounting, now dispute comes. That's why the available amount is less. Available amount is less, but amount due to partners. I repeat, amount due to partners are more. How do we deal with this situation or scenario? That is the concept. Here we have two methods. One is maximum possible loss method. Second one is highest relative capital method or surplus capital method or proportionate capital method. Sir, which method is important, sir? We cannot say, because in the examination they may ask any method. Sir, what is maximum loss method? What is highest relative capital method? Now we enter into that. Look at maximum loss method. Here we have to follow certain steps. First one, prepare a statement showing distribution of cash. We are realizing the assets, na? Yes, sir. Out of the proceeds of realization, how you are distributing the amount? So prepare a statement showing distribution of cash. After that, pay off the external liabilities. Out of the proceeds, first pay off the external liabilities. Okay, sir. After all the payment is made for external liabilities, the partners will be paid off. Yes or no? Yes, sir. All the liabilities are paid, sir. Now the next preference is to partners. Okay. Check how much is the amount due to partner. Suppose, let us say the amount due to partner is 1 lakh, sir. Acha. Okay, fine. Deduct the amount available. Sir, amount available is just 5,000, sir. Amount available is just 5,000. Then tell me, what is the deficiency amount? How much amount we are unable to pay? Sir, 95,000, sir. Do one thing. Treat this 5,000 as final settlement. Assume remaining assets we have to realize. There are some assets to realize, but at present, I have only 5,000 rupees. Okay. If this is the final settlement, assume in your mind, if this is the final settlement, then how do you settle the partner's capital account? If this is the final settlement, then how do you settle the partner's capital account? Tell me. Yes, sir, I will do one thing. Whatever the remaining amount of loss is there, this loss, first I will distribute to the partners in their profit sharing ratio. Fine. After distribution of this 95,000 rupees, if all partners capital accounts shows credit balance of 5,000, ultimately partners capital account shows credit balance of 5,000, and this 5,000 I will pay to them. Okay. Suppose if any partner account shows debit balance, then what is the scenario? This 95,000 we are distributing now. This 95,000 rupees we are distributing. Yes. During the distribution of this 95,000, if any partner capital account shows debit balance, then what is the scenario? Sir, partner capital account shows debit balance means he has to bring the amount to the firm now, sir. Yes, why not? But what that particular partner says, hello, mister, this is just imagination. This is just imagination, not actual, na. Why, sir? Already we have assets to realize. Why are you asking me amount? Why are you asking me amount of deficiency? Already we have assets na. Yes. Okay. Then this is treated as notional deficiency. Notional deficiency. We treat that particular partner as notional insolvent. Notional insolvent. He is not actually insolvent. We imagine he is insolvent. Then what is the procedure? Okay. What is the amount to due from him? So and so amount. When a particular partner is insolvent, then what is the rule we follow? Garner versus Murray rule. What is the rule of Garner versus Murray? Distribute the deficiency amount to remaining partners. The same logic we follow here. Till the repayment of last installment, we follow this procedure. What is that? First we take what is the total amount due to partner. Before distribution of amount to the partners, we take what is the amount due to the partner minus available cash. Remaining amount is treated as maximum loss. We treat every settlement, every installment is the last and final installment. In that manner, we start distributing amount to the partners. During the process of distribution of maximum loss, if any partner capital account shows debit balance, means negative, then the negative amount is redistributed to the solvent partners in their capital ratio. So that here we have to follow Garner versus Murray rule. Okay, next. The maximum loss shall be shared amongst the partners in their profit sharing ratio as if there will be no further realization. Now, whatever the steps I have followed, I have discussed till now the same steps here. Based on this, we try to solve one problem. I repeat, students, this method is very, very important. Maximum loss method, piecemeal distribution, piecemeal payment is important. Why? Because since 2 attempts they are not asked, they have not asked a question from this concept. Now look at illustration 6. Observe illustration 6. Maximum loss method. First one, read. A, B and C are partners sharing profits and losses in the ratio of 5:3:2. Their capitals were 9,600, 6,000, 8,400 respectively. Fine. After paying creditors, the liabilities and assets of the firm were, look at, liability for interest on loans from spouse of partner. Spouse of partner is always taken as outside liability, and partner's loan or any interest due to partner is taken as internal liability, separately paid. Investments we have 1,000, furniture we have 2,000, machinery 1,200, stock 4,000. The assets realized in full in order in which they are listed above. Means first investments realized, after that furniture realized, after that machinery realized, after that stock realized. Okay, you are required to prepare a statement showing the distribution of cash as and when available, applying the maximum possible loss procedure. First we prepare distribution table. Look at here. First observe this table. First column, realization steps, one by one we write. Second column, realized amount we write. Third column, first amount due to spouse of a partner. Second, interest due to loan on partner. Third, partner's capital. Third preference, total. First look at who are the partners, A, B, C. First write down amounts due. How much amount we have to pay interest to spouse of a partner? 2,000. Loan on interest, partner's loan, interest on partner's loan 1,000. A, B, C. These are the total amounts we have to pay. What is the total amount we have? 24,000. This much of amount we have to repay. Okay. What is the first realization? 1,000 is the first realization. 1,000 to whom we pay? First we pay interest on loan from spouse of a partner. This 1,000 rupees is paid. Sale of investments. How much amount received? 1,000. This 1,000 first I am paying to interest on loan taken from spouse of a partner. Okay. After payment of 1,000, tell me the remaining balances. 1,000 rupees still payable. Here 1,000 rupees still payable. Second realization is what? Second realization, furniture. How much realized furniture? 2,000. Out of this 2,000, first pay amount to partner's loan from partner spouse. After that, loan from partner. Observe, all outside liabilities are repaid. Now only the amount pending to A, B, C. How much payable? 9,600, 6,000 and 8,400. And what is the third realization? Tell me. Third realization, machinery. How much amount we have here? 1,200. But what is the amount due to all partners? 9,600 plus 6,000 plus 8,400. Total amount is 24,000 payable to partners. But how much amount you have? 1,200. What is the deficiency here? 22,800. 22,800 is the deficiency. Now this deficiency is shared among A, B, C in 5:3:2 ratio. That is what we have to do now. Look at sale of machinery. How much amount we received? 1,200. What is the maximum loss? Tell me now. 22,800. How we arrived this maximum loss 22,800? Amount due to all partners 24,000 minus 1,200 available cash. Maximum loss 22,800. And this maximum loss is distributed to all partners in their profit sharing ratio 5:3:2. How much we are getting? Tell me. 11,400, 6,840, 4,560. Total 22,800. Next, here amount. See, amount in the bracket in the sense this particular partner should bring that amount. This particular partner should bring that amount. Look at what is the amount due to A? 9,600. But here we have distributed loss. How much loss we have distributed? 11,400. Means actually, if this is the final payment, A has to bring 1,800 rupees to the firm. To B we have to pay 6,000, but amount due from him, sorry, amount of loss distributed 6,840. If this is the final settlement, he has to bring 840 to the firm. If he brings 1,800 and 840, then we repay amount to C. Observe, to C we have to pay 8,400. Last distribution 4,560. How much amount payable to C? 3,840. How much amount payable to C? 3,840. But how much cash we have? 1,200. We need more. How much? 2,640. Who has to bring this 2,640? 1,800 by A, 840 by B. But you people tell me, will they bring this amount? No, sir. Now what we have to do? Redistribute this 1,800 and 840 to C. Over. See, deficiency. Deficiency of A and B written off against C. Look at 1,800, 840, total 2,640. Deduct. A account shows 0 balance now, B account shows 0 balance, and C account shows 1,200 balance. C account shows 1,200 balance. Now whatever the 1,200 we have, pay that 1,200 to C first. Pay that 1,200 to C. Over. Next one. Balance in capital accounts. After payment of 1,200, how much capital account, how much amount showing capitals? A 9,600, B 6,000 as usual. C, to see how much amount we have to pay actually 8,400 minus how much amount paid 1,200, remaining amount payable 7,200. Is it clear, students? Yes. Now last asset realized 400, sorry 4,000. But what is the amount payable to partners total? What is the amount payable to partners total? 22,800. 22,800. But how much is the available cash? 4,000 is the available cash. 22,800 minus, just a minute, 22,800 minus 4,000, 18,800 becomes 18,800 becomes maximum loss, and this 18,800 is distributed among partners in their 5:3:2 ratio. Distribute 9,400, 5,640, 3,760. Deduct. What is the meaning of this? Amount due to A 9,600, loss distributed 9,400, still the business has to pay 200. Next, B, amount due to B 6,000, amount distributed 5,640, loss distributed, remaining amount 360. Next, amount due to C 7,200, loss distributed 3,760, remaining amount 3,440. Now finally To all partners ABC, we pay 4,000 rupees. How? 200, 360, 3,440. Ultimate loss should be borne by all partners. How much? 9,400. How do we get it? 9,600 minus 200, we get 9,400. 6,000 minus 360 paid, remaining balance we get 5,640. 7,200 payable to C, paid 3,440, not able to pay 3,760. These are the final loss borne by remaining partners. This is the distribution table. This is how we have to prepare the distribution table. Clear, everybody? This is maximum loss. I repeat, we may expect this piecemeal distribution in the exam. Don't forget. Next one. After that, highest relative capital method. Highest relative capital method. Now, before distribution of amount, see that if partners' capitals are in proportion to their profit sharing ratio, I repeat, where is the problem coming? Where is the problem coming? Sir, the problem comes at the time of distribution of amount to partners, sir. Okay. The problem comes how the amount, the available amount is distributed to partners, sir. Super. Do one thing. Check amount due to partners. If the amount due to partners is in relation to or in proportion to their profit sharing ratio, then distribute the available cash in profit sharing ratio. Suppose if the amount due to partners is not in proportion to their capital ratio, then follow this method, highest relative capital method. In the problem they specify. Here what are the steps we have to follow? Instead of discussing all these steps orally, let us take one example so that you can understand. Na? So here I am taking highest relative capital method. One problem I am taking, very important. Look at. Easy but important. Here writing part is more. And do remember, under piecemeal payments, you are not going to prepare any single ledger account. I repeat, under piecemeal payments, you are not going to prepare any single ledger account. Only thing you are going to prepare statement, distribution table. A partnership firm was dissolved on 30th June 2022. Fine. Its balance sheet on the date of dissolution was as follows. Look at the balance sheet. These are the capital account balances. And loan account, B loan account, 10,000, sundry creditors 30,000. First, to whom the amount is paid, sundry creditors 30,000. Second, to whom the amount is paid, loan to B 10,000. After that, we start repaying amount due to partners. Now, cash balance we have 10,800 and sundry data, sundry assets we have 1,89,200. First, we have 10,800. Now, this amount we distribute to creditors. First, we have 10,800. Give the amount to creditors. But before distribution of this 10,800, the liquidator or the person who is responsible for this dissolution process, he will keep some amount of money for realization expenses. I repeat, out of this 10,800, the person who is responsible for this dissolution process, he will keep some amount for realization expenses. He has that right. And the remaining amount is distributed. Okay, now look at it. The assets were realized in installments. Assets realized in installments. And the payments were made on the proportionate capital basis. Proportionate capital basis means highest relative capital method. Creditors were paid 29,000 in full settlement of their account. Sir, we received 1,000 discount, na sir. No need to worry. You pay 29,000 over. Expenses of realization were estimated to be 5,400. But actual amount spent was 4,000. Now you people tell me, out of the first amount of 10,800, what the official liquidator he will do? He will keep 5,400 rupees aside. And he will start distributing the remaining amount 5,400. So he kept 5,400 na? Yes sir. But if we see the actual amount of expense, the actual amount of expense is 4,000. The actual amount of expense is 4,000, and this amount was paid on 15th September. Means we have minimized the expense of 1400 now by 1400. Yes, at the final settlement or at the final realization amount or installment amount, we add more 1500 rupees, sorry, 1400 rupees, and we distribute amount to partners. Drop a statement showing distribution of cash which was realized as follows. Here sundry assets total 1,89,200. How the sundry assets realized? Look at, on 5th July 2022, 25,200 realized. On 30th August 2022, 60,000 realized. On 15th September 2022, 80,000 realized. On the date of realization, how do you distribute this amount and to whom this amount is distributed? That you need to identify. Okay, sir, fine. The partners shared profits and losses in the ratio of 2 to 1. Okay, prepare a statement showing distribution of cash amongst the partners by highest relative capital method. Fine, sir. Prepare a statement like this. First, statement showing distribution of cash. First, write down order of payments. First, we have to pay amount to creditors. Next, we have to pay amount to B's loan. After that, A, B, C. Write down amounts due first. 30th June, what is the amount due? 30,000, 10,000, 76,000, 48,000 and 36,000. After that, at present, how much balance you have? Sir, I have 10,800, sir. From 10,800, you keep 5,400 for expenses and remaining 5,400, first you give it to creditors, sir. Yes, sir, I am doing the same. Cash balance less provision for expenses, 5,400 I distributed. After distribution of 5,400, how much balance left? 30,000 minus 5,400, 24,600. B's loan as it is 10,000, A, B, C capitals as it is. Next, on 5th July, how much amount realized? 25,200. First, pay amount to creditors. What is the amount due to creditors? 24,600. Whereas 1,000 rupees they allow discount na. So how much amount we pay? 23,600. We have extra 1,600 rupees, and next pass this amount to B's loan, 1,600. After repayment of this 25,200. What is the remaining amount left? Discount received 1,000, and this discount we transfer to realization account. Finally, now remaining amount left. To B we have to pay 8,400, C 76, A 76, B 48 and C 36,000. Now come to second realization. Second realization 60,000. Okay, out of 60,000, first pay 8,400 to B's loan. Okay, sir, I have paid 8,400 to B's loan. What is the amount left? Sir, 51,600 amount left, sir. 51,600 amount left, sir. Okay, good. Now, next priority, this 51,600 I have to distribute to all partners. Okay, but how much amount payable to partners? Tell me. 76,000 plus 48,000 plus 36,000. Total amount payable 1,60,000, sir. But I have 51,600, sir. Okay, what's the remaining amount payable? 1,08,400, sir. If it is the maximum loss method, we distribute 1,08,400 to partners. If it is the maximum loss method, then we distribute 1,08,400 to partners. But it is not maximum loss method. It is highest relative capital method. Means out of 3 partners, whose capital is more in proportion to their profit sharing ratio, now we have to calculate. For this, go to a working note. Highest relative capital, working note. This working is very, very important. First, what we have to do? First, write down the present capitals. It is a sequential step, students. Sequence of steps. Follow these steps as it is. First, sir, present capital is how much? Present capital 76, 48, 36. Okay. Present profit sharing ratio how much? Sir, 2 to 1. Okay. Divide. Calculate per unit profit share. Capital per unit of profit share. Means 76,000 is the total capital divided by profit share is 2. Means we get 38,000. B, 48,000 is the capital, profit share 2 divided by 2, 24,000. C, 36,000 divided by 1, 36,000. And this is called capital per unit of profit share. Capital per unit of profit share. Okay. We have calculated capital per unit of profit share. Out of them, identify least capital per unit of profit share. Sir, least one is 24,000, sir. 24,000. Now multiply 24,000 with the profit share. Multiply 24,000 with the profit share. 24,000 into 2, 48,000. 24,000 into 2, 48,000. 24,000 into 1, 24,000. Means, actually if we see, the capitals must be like this. Capitals must be like this, 48,000, 48,000, 24,000 in proportion to their profit share. That is the fourth point. Proportionate capitals taking B whose capital is at least as the basis. Okay, fourth point. Now calculate excess capital. Actual capital must be 48,000. Just a minute. 48,000, 48,000 and 24,000. But originally how much capitals are there? 76, 84, 36. Calculate the difference. 76 minus 38, 24. 48 minus 48, 0. 36 minus 24, 12,000. Means here we have excess capitals of A and C. A and C. Now the question comes. Among A and C, to whom the amount is payable first? Among A, B, C, to whom the amount is payable first? To A and B. Sorry, A and C. Okay, for two people we have to pay amount. Now, among A and C, to whom the amount is payable? Among A and C, to whom the amount is payable? To know to whom the amount is payable, first among A and C, follow the procedure from third step once again. Follow the same procedure which we have followed in case of third step. What is that? Profit sharing ratio to 1. Profit sharing ratio to 1. This time exclude A. Calculate capital per unit of profit share. Calculate capital per unit of profit share again. 5 by 6. 24,000 divided by 2, 14,000. 12,000 divided by 1, 12,000. Again take least capital per unit per share. Least capital per unit per share. 12,000, sir. 12,000, sir. Multiply 12,000 with the profit share. 12,000 into 2, 24,000. 12,000 into 1, 12,000. Now tell me the difference of, here they have given steps, students. You have to follow these steps. No other alternative. No other alternative. Okay. What is the earlier amount payable? Excess amount 24,000. 28,000, sir. Earlier amount is payable 28,000. Now it is 24,000, sir. How much is excess capital? 4,000, sir. Now tell me, among A, B, C, first we have to pay amount to A and C. Among A and C, first to whom the amount is payable? To A. How much amount we pay first? 4,000. 4,000 is excess. 4,000. Next we pay 24,000 and 12,000 to A and C. Total excess capital is how much? 28,000. Out of 28,000, first we have to pay 4,000 and remaining 24,000 is payable. Now how much excess capital of C? 12,000. 12,000 pay later. After payment of this 28,000 and 12,000 to A and C, whatever the remaining amount available with us, that is paid to all partners A, B, C according to 2:2:1 ratio. Why? Now here we set, in step 4, we set the partners capital according to their profit sharing ratio. 48,000, 48,000 and 24,000. Till the repayment of this 28,000 and 12,000, First we have to pay amount to A and C. After repayment of this 28,000 and 12,000, we start repaying amount to remaining partners A, B, C in 2 to 1 ratio. This is the procedure we have to follow. Based on that, look at the distribution sequence. First 4,000. Total amount is payable to A. Next 36,000. How, sir? 24,000 plus 12,000, 36,000. Next 36,000 is paid according to 2 is to 0 is to 1. Means 0 means no need to pay any amount to B. 36,000 is paid according to 2 is to 1 ratio. 24,000, 12,000. And over 40,000 means 28,000 to A, 12,000 to B, total 40,000. After making payment of 40,000 to A and C, whatever the remaining amount we have, that is distributed to all partners in 2 is to 1. Okay, next. Now distribution of second installment. What is the second installment? Second installment amount we have 51,600. Total second installment we have 60,000. Out of that, first we have paid 8,400 to partners loan. Okay, first 8,400 we have paid to creditors. Not creditors actually, B's loan. B is not B's loan. Here you can write B's loan. First 8,400 paid to B's loan. Next 4,000 paid to A. Next 36,000 paid to A and B. 24,000 plus 12,000. Out of 60,000, after making payment of these things, what is the remaining amount left? 11,600, and this 11,600 is paid in 2 is to 1 ratio. Finally, how much amount is paid to A? 32,640 total. B 4,640. C 14,320. The same amounts are substituted here. Amounts are substituted here. Look at here. 8,400, 32,640, 4,640, 14,320. What is the balance left? B's loan cleared. A, how much amount is payable? 76,000 minus 32,640, we get 43,360. 48,000 minus 4,640, we get 43,360. 36,000 is the amount payable to C. Now we are paying 14,320, amount due 21,680. Now last realization how much? 80,000. Now this 80,000 is paid to A, B and C in 2 to 1 ratio. 2 to 1 ratio. Look at how much amount realized? 80,000. How much amount saved in expenses? 1,400. Total how much amount we have now? 81,400. This amount is distributed to A, B, C in 2 to 1 ratio. 32,560, 32,560, 16,280. Finally, whatever the amounts left, that becomes loss for partners. This much of loss they have to bear. After preparing this statement, now the accountant, by looking this statement, accountant will record the entries. I repeat, by looking this statement, the accountant start recording entries. This statement is prepared by the official liquidator. Accountant is different, official liquidator is different. After taking this statement from the official liquidator, we start recording the entries in the books of accounts. Is it clear, students? Yes, this is our highest relative capital method. Don't neglect this method, maximum loss method and highest relative capital method. You will get either one. We are expecting based on previous 3 attempts, right? This is our whole partnership accounts, students. With this, I am stopping the live session now. I thought to complete company accounts also, but due to time constraint, I was unable to complete company accounts, right? So company accounts you try to prepare, but if you have any doubts in company accounts, tomorrow morning session from 8 o'clock to 12 o'clock, from 8 o'clock to 12 o'clock I am available. You can, whatever the doubts you have in accounting subject, you can send your queries to my number 9573778943. You can send telegram. You can send telegram to this number. I will quickly respond to your query. Is it clear? So this much support I can give you tomorrow morning from 8 o'clock to 12 o'clock. So I will wait for your doubts. I am ready to clarify between 8 to 12. And tomorrow evening we meet again with question paper analysis. If possible, live session, or else recorded session. But by tomorrow 7 o'clock or 8 o'clock, I will post question paper analysis. So all the best students for your tomorrow's exam. Do remember one thing, to the extent possible, try to solve and come. I repeat, to the extent possible, try to solve and come. Believe me, suppose the question paper is 100% tough, sir. The total question paper is for 125 marks, including internal choice. But you have to attempt it for 100 marks. Suppose total question paper is difficult, sir. Yes, even though you have a scope to get minimum 40 to 50 marks, don't leave even single question. Don't leave even single question. Do remember, try to do the problem as much as possible with the process. I have completed final accounts of in for part 1 marathon. Part 1 is there we have discussed category A chapters. In these live sessions we have completed final accounts, NPO, incomplete records, and this partnership accounts. Now I have discussed a strategy how to solve the problems. Follow the process. To the extent possible, you can complete the answer. Forget about the final answer. If you do the process correctly, if you write the amounts, or if you write the items and amounts in the appropriate place, automatically you get the final answer correct. If you will not get any final answer, suppose if you don't get any final answer correct, even though ignore, but you get stepwise marking now. That is the advantage of this accounts paper. So tomorrow, share your question paper. How did you write your question paper in the comment section? Tomorrow we post question paper analysis. That's it, students. So all the very best for your tomorrow's exam. Tomorrow is the first exam, and first exam must be best exam. Is it clear? So all the best, my dear students. We meet again tomorrow. Till then, bye bye. Good night, everybody.